Macroeconomics, 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 macroeconomics. Textbook in Economics for Class 12. Contents. F. 1. I. 1. 1.1 Emergence of Macroeconomics 5. 2. Introduction, 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 introduction. You must have already been introduced to a study of basic microeconomics. This chapter begins by giving you a simplified account of how macroeconomics differs from the microeconomics that you have known. Those of you who will choose later to specialize in economics for your higher studies will know about the more complex analyses that are used by economists to study macroeconomics today. But the basic questions of the study of macroeconomics would remain the same, and you will find that these are actually the broad economic questions that concern all citizens. Will the prices as a whole rise or come down? Is the employment condition of the country as a whole, or of some sectors of the economy, getting better or is it worsening? What would be reasonable indicators to show that the economy is better or worse? What steps, if any, can the state take or the people ask for in order to improve the state of the economy? These are the kind of questions that make us think about the health of the country's economy as a whole. These questions are dealt within macroeconomics at different levels of complexity. In this book, you will be introduced to some of the basic principles of macroeconomic analysis. The principles will be stated, as far as possible, in simple language. Sometimes elementary algebra will be used in the treatment for introducing the reader to some rigor. If we observe the economy of a country as a whole, it will appear that the output levels of all the goods and services in the economy have a tendency to move together. For example, if output of food grain is experiencing a growth, it is generally accompanied by a rise in the output level of industrial goods. Within the category of industrial goods, also output of different kinds of goods tend to rise or fall simultaneously. Similarly, prices of different goods and services generally have a tendency to rise or fall simultaneously. We can also observe that the employment level in different production units also goes up or down together. If aggregate output level, price level, or employment level in the different production units of an economy bear close relationship to each other, then the task of analyzing the entire economy becomes relatively easy. Instead of dealing with the above-mentioned variables at individual, disaggregated levels, we can think of a single good as the representative of all the goods and services produced within the economy. This representative good will have a level of production which will correspond to the average production level of all the goods and services. Similarly, the price or employment level of this representative good will reflect the general price and employment level of the economy. In macroeconomics, we usually simplify the analysis of how the country's total production and the level of employment are related to attributes called variables, like prices, rate of interest, wage rates, profits, and so on, by focusing on a single imaginary commodity and what happens to it. We are able to afford this simplification and thus usefully abstain from studying what happens to the many real commodities that actually are bought and sold in the market, because we generally see that what happens to the prices, interests, wages, and profits, etc. for one commodity more or less also happens for the others. Particularly when these attributes start changing fast, like when prices are going up in what is called an inflation, or employment and production levels are going down, heading for a depression, the general directions of the movements of these variables for all the individual commodities are usually of the same kind as are seen for the aggregates for the economy as a whole. We will see below why, sometimes, we also depart from this useful simplification when we realize that the country's economy as a whole may best be seen as composed of distinct sectors. For certain purposes, the interdependence of, or even rivalry between, two sectors of the economy, agriculture and industry, for example, or the relationships between sectors, like the household sector, the business sector, and government in a democratic setup, help us understand some things happening to the country's economy much better than by only looking at the economy as a whole. While moving away from different goods and focusing on a representative good may be convenient, in the process, we may be overlooking some vital distinctive characteristics of individual goods. For example, production conditions of agricultural and industrial commodities are of a different nature. Or, if we treat a single category of labor as a representative of all kinds of labors, we may be unable to distinguish the labor of the manager of a firm from the labor of the accountant of the firm. So, in many cases, instead of a single representative category of good or labor or production technology, we may take a handful of different kinds of goods. For example, 3 general kinds of commodities may be taken as a representative of all commodities being produced within the economy: agricultural goods, industrial goods, and services. These goods may have different production technology and different prices. Macroeconomics also tries to analyze how the individual output levels, prices, and employment levels of these different goods gets determined. From this discussion here, and your earlier reading of microeconomics, you may have already begun to understand in what way macroeconomics differs from microeconomics. To recapitulate briefly, in microeconomics you came across individual economic agents, CBOCs, and the nature of the motivations that drive them. They were micro, meaning small agents, consumers choosing their respective optimum combinations of goods to buy, given their tastes and incomes, and producers trying to make maximum profit out of producing their goods, keeping their costs as low as possible and selling at a price as high as they could get in the markets. In other words, microeconomics was a study of individual markets of demand and supply, and the players, or the decision makers, were also individuals, buyers or sellers, even companies, who were seen as trying to maximize their profits, as producers or sellers, and their personal satisfaction or welfare levels, as consumers. Even a large company was micro, in the sense that it had to act in the interest of its own shareholders, which was not necessarily the interest of the country as a whole. For microeconomics, the macro, meaning large, phenomena affecting the economy as a whole, like inflation or unemployment, were either not mentioned or were taken as given. These were not variables that individual buyers or sellers could change. The nearest that microeconomics got to macroeconomics was when it looked at general equilibrium, meaning the equilibrium of supply and demand in each market in the economy. Macroeconomics tries to address situations facing the economy as a whole. Adam Smith, the founding father of modern economics, had suggested that if the buyers and sellers in each market take their decisions following only their own self-interest, economists will not need to think of the wealth and welfare of the country as a whole separately. But economists gradually discovered that they had to look further. Economists found that first, in some cases, the markets did not or could not exist. Secondly, in some other cases, the markets existed but failed to produce equilibrium of demand and supply. Thirdly, and most importantly, in a large number of situations, society or the state or the people as a whole had decided to pursue certain important social goals unselfishly in areas like employment, administration, defense, education, and health, for which some of the aggregate effects of the microeconomic decisions made by the individual economic agents needed to be modified. For these purposes, macroeconomists had to study the effects in the markets of taxation and other budgetary policies, and policies for bringing about changes in money supply, the rate of interest, wages, employment, and output. Macroeconomics has economic agents. By economic units or economic agents, we mean those individuals or institutions which take economic decisions. They can be consumers who decide what and how much to consume. They may be producers of goods and services who decide what and how much to produce. They may be entities like the government, corporation, banks, which also take different economic decisions like how much to spend, what interest rate to charge on the credits, how much to tax, etc. Therefore, deep roots in microeconomics because it has to study the aggregate effects of the forces of demand and supply in the markets. However, in addition, it has to deal with policies aimed at also modifying these forces if necessary to follow choices made by society outside the markets. In a developing country like India, such choices have to be made to remove or reduce unemployment, to improve access to education and primary health care for all, to provide for good administration, to provide sufficiently for the defense of the country, and so on. Macroeconomics shows two simple characteristics that are evident in dealing with the situations we have just listed. These are briefly mentioned below. First, who are the macroeconomic decision makers or players? Macroeconomic policies are pursued by the state itself or statutory bodies like the Reserve Bank of India, RBI, Securities and Exchange Board of India, SEBI, and similar institutions. Typically, each such body will have one or more public goals to pursue as defined by law or the Constitution of India itself. These goals are not those of individual economic agents maximizing their private profit or welfare. Thus, the macroeconomic agents are basically different from the individual decision makers. Secondly, what do the macroeconomic decision makers try to do? Obviously, they often have to go beyond economic objectives and try to direct the deployment of economic resources for such public needs as we have listed above. Such activities are not aimed at serving individual self-interests. They are pursued for the welfare of the country and its people as a whole. Adam Smith is regarded as the founding father of modern economics. It was known as political economy at that time. He was a Scotsman and a professor at the University of Glasgow. Philosopher by training, his well-known work An Inquiry into the Nature and Cause of the Wealth of Nations, 1776, is regarded as the first major comprehensive book on the subject. The passage from the book: "It is not from the benevolence of the butcher, the brewer, of the baker that we expect our dinner, but from their regard to their own interest. We address ourselves not to their humanity but to their self-love, and never talk to them of our own necessities but of their advantage," is often cited as an advocacy for free market economy. The physiocrats of France were prominent thinkers of political economy before Smith. Adam Smith. 1.1 Emergence of macroeconomics as a separate branch of economics emerged after the British economist John Maynard Keynes published his celebrated book The General Theory of Employment, Interest and Money in 1936. The dominant thinking in economics before Keynes was that all the laborers who are ready to work will find employment and all the factories will be working at their full capacity. This school of thought is known as the classical tradition. However, the Great Depression of 1929 and the subsequent years saw the output and employment levels in the countries of Europe and North America fall by huge amounts. It affected other countries of the world as well. Demand for goods in the market was low, many factories were lying idle, workers were thrown out of jobs. In USA, from 1929 to 1933, unemployment rate rose from 3% to 25%. Unemployment rate may be defined as the number of people who are not working and are looking for jobs divided by the total number of people who are working or looking for jobs. Over the same period, aggregate output in USA fell by about 33%. These events made economists think about the functioning of the economy in a new way. The fact that the economy may have long-lasting unemployment had to be theorized about and explained. Keynes' book was an attempt in this direction. Unlike his predecessors, his approach was to examine the working of the economy in its entirety and examine the interdependence of the different sectors. The subject of macroeconomics was born. John Maynard Keynes, British economist, was born in 1883. He was educated in King's College, Cambridge, United Kingdom, and later appointed its dean. Apart from being a sharp intellectual, he actively involved in international diplomacy during the years following the First World War. He prophesied the breakdown of the peace agreement of the war in the book The Economic Consequences of the Peace, 1919. His book General Theory of Employment, Interest and Money, 1936, is regarded as one of the most influential economics books of the 20th century. He was also a shrewd foreign currency speculator. John Maynard Keynes. 66666 Introductory Macroeconomics. 1.2c On text of the present book Macroeconomics. We must remember that the subject under study has a particular historical context. We shall examine the working of the economy of a capitalist country in this book. In a capitalist country, production activities are mainly carried out by capitalist enterprises. A typical capitalist enterprise has one or several entrepreneurs, people who exercise control over major decisions and bear a large part of the risk associated with the firm/enterprise. They may themselves supply the capital needed to run the enterprise, or they may borrow the capital. To carry out production, they also need natural resources, a part consumed in the process of production, e.g. raw materials, and a part fixed, e.g. plots of land. And they need the most important element of human labor to carry out production. This we shall refer to as labor. After producing output with the help of these three factors of production, namely capital, land, and labor, the entrepreneur sells the product in the market. The money that is earned is called revenue. Part of the revenue is paid out as rent for the service rendered by land, part of it is paid to capital as interest, and part of it goes to labor as wages. The rest of the revenue is the earning of the entrepreneurs, and it is called profit. Profits are often used by the producers in the next period to buy new machinery or to build new factories so that production can be expanded. These expenses which raise productive capacity are examples of investment expenditure. In short, a capitalist economy can be defined as an economy in which most of the economic activities have the following characteristics. A. There is private ownership of means of production. B. Production takes place for selling the output in the market. C. There is sale and purchase of labor services at a price which is called the wage rate. The labor which is sold and purchased against wages is referred to as wage labor. If we apply the above-mentioned four criteria to the countries of the world, we would find that capitalist countries have come into being only during the last 300 to 400 years. Moreover, strictly speaking, even at present, a handful of countries in North America, Europe, and Asia will qualify as capitalist countries. In many underdeveloped countries, production, in agriculture especially, is carried out by peasant families. Wage labor is seldom used, and most of the labor is performed by the family members themselves. Production is not solely for the market, a great part of it is consumed by the family. Neither do many peasant farms experience significant rise in capital stock over time. In many tribal societies, the ownership of land does not exist, the land may belong to the whole tribe. In such societies, the analysis that we shall present in this book will not be applicable. It is, however, true that many developing countries have a significant presence of production units which are organized according to capitalist principles. The production units will be called firms in this book. In a firm, the entrepreneur, or entrepreneurs, is at the helm of affairs. She hires wage labor from the market, she employs the services of capital and land as well. After hiring these inputtesetasheendeartaskefproductionhermmotivefo are producing goods and services referred to as output, is to sell them in the market and earn profits. In the process, she undertakes risks and uncertainties. For example, she may not get a high enough price for the goods she is producing. This may lead to fall in the profits that she earns. It is to be noted that in a capitalist country, the factors of production earn their incomes through the process of production and sale of the resultant output in the market. In both the developed and developing countries, apart from the private capitalist sector, there is the institution of state. The role of the state includes framing laws, enforcing them, and delivering justice. The state, in many instances, undertakes production apart from imposing taxes and spending money on building public infrastructure. RUNNINGSCHOOLSCOLLEGES. PROVIDINGHEALTHSERVICESETC. Economic functions of the state have to be taken into account when we want to describe the economy of the country. For convenience, we shall use the term government to denote state. Apart from the firms and the government, there is another major sector in an economy which is called the household sector. By a household, we mean a single individual who takes decisions relating to her own consumption, or a group of individuals for whom decisions relating to consumption are jointly determined. Households also save and pay taxes. How do they get the money for these activities? We must remember that the households consist of people. These people work in firms as workers and earn wages. They are the ones who work in the government departments and earn salaries, or they are the owners of firms and earn profits. Indeed, the market in which the firms sell their products could not have been functioning without the demand coming from the households. Moreover, they can also earn rent by leasing land or earn interest by lending capital. Suggested readings. 1. Baduri, A. 1990. Macroeconomics. Macroeconomics. The Dynamics of Commodity Production. Pages 1 to 27. Macmillan India Limited, New Delhi. 2. Mankiw, N. G. 2000. Macroeconomics, pages 2 to 14, Macmillan Worth Publishers, New York. So far we have described the major players in the domestic economy. But all the countries of the world are also engaged in external trade. The external sector is the fourth important sector in our study. Trade with the external sector can be of two kinds. 1. The domestic country may sell goods to the rest of the world. These are called exports. 2. The economy may also buy goods from the rest of the world. These are called imports. Besides exports and imports, the rest of the world affects the domestic economy in other ways as well. 3. Capital from foreign countries may flow into the domestic country, or the domestic country may be exporting capital to foreign countries. Macroeconomics deals with the aggregate economic variables of an economy. It also takes into account various interlinkages which may exist between the different sectors of an economy. This is what distinguishes it from microeconomics, which mostly examines the functioning of the particular sectors of the economy, assuming that the rest of the economy remains the same. Macroeconomics emerged as a separate subject in the 1930s due to Keynes. The Great Depression, which dealt a blow to the economies of developed countries, had provided Keynes with the inspiration for his writings. In this book, we shall mostly deal with the working of a capitalist economy. Hence, it may not be entirely able to capture the functioning of a developing country. Macroeconomics sees an economy as a combination of four sectors, namely households, firms, government, and external sector. Summary Key concepts EY concepts 1. What is the difference between microeconomics and macroeconomics? 2. What are the important features of a capitalist economy? 3. Describe the four major sectors in an economy according to the macroeconomic point of view. 4. Describe the Great Depression of 1929. Exercises. Rate of interest, wage rate, profits, economic agents or units, Great Depression, unemployment rate, 4 factors of production, means of production, inputs, land, labor, capital, entrepreneurship, investment, expenditure, wage, labor, capitalist country or capitalist economy, firms, capitalist firms, output, households, government, external sector, exports, imports. National income, accounting, national income, accounting, national income, accounting, national income, accounting, national income, accounting. In this chapter, we will introduce the fundamental functioning of a simple economy. In section 2.1, we describe some primary ideas we shall work with. In section 2.2, we describe how we can view the aggregate income of the entire economy going through the sectors of the economy in a circular way. The same section also deals with the 3 ways to calculate the national income, namely product method, expenditure method, and income method. The last section, 2.3, describes the various subcategories of national income. It also defines different price indices like GDP deflator, consumer price index, wholesale price indices, and discusses the problems associated with taking GDP of a country as an indicator of the aggregate welfare of the people of the country. 2.1 SBC Concepts of Macroeconomics. One of the pioneers of the subject we call in economics today, Adam Smith, named his most influential work, An Inquiry into the Nature and Cause of the Wealth of Nations. What generates the economic wealth of a nation? What makes countries rich or poor? These are some of the central questions of economics. It is not that countries which are endowed with a bounty of natural wealth, minerals or forests, or the most fertile lands, are naturally the richest countries. In fact, the resource-rich Africa and Latin America have some of the poorest countries in the world, whereas many prosperous countries have scarcely any natural wealth. There was a time when possession of natural resources was the most important consideration, but even then the resource had to be transformed through a production process. The economic wealth or well-being of a country thus does not necessarily depend on the mere possession of resources. The point is how these resources are used in generating a flow of production and how, as a consequence, income and wealth are generated from that process. Let us now dwell upon this flow of production. How does this flow of production arise? People combine their energies with natural and man-made environment within a certain social and technological structure to generate a flow of production. In our modern economic setting, this flow of production arises out of production of commodities, goods, and services by millions of enterprises, large and small. These enterprises range from giant 10 Introductory Macroeconomics corporations employing a large number of people to single entrepreneur enterprises. But what happens to these commodities after being produced? Each producer of commodities intends to sell her output. So from the smallest items like pins or buttons to the largest ones like airplanes, automobiles, giant machinery, or any saleable service like that of the doctor, the lawyer, or the financial consultant, the goods and services produced are to be sold to the consumers. The consumer may, in turn, be an individual or an enterprise, and the good or service purchased by that entity might be for final use or for use in further production. When it is used in further production, it often loses its characteristic as that specific good and is transformed through a productive process into another good. Thus, a farmer producing cotton sells it to a spinning mill where the raw cotton undergoes transformation to yarn. The yarn is, in turn, sold to a textile mill where, through the productive process, it is transformed into cloth. The cloth is, in turn, transformed through another productive process into an article of clothing which is then ready to be sold finally to the consumers for final use. Such an item that is meant for final use and will not pass through any more stages of production or transformations is called a final good. Why do we call this a final good? Because once it has been sold, it passes out of the active economic flow. It will not undergo any further transformation at the hands of any producer. It may, however, undergo transformation by the action of the ultimate purchaser. In fact, many such final goods are transformed during their consumption. Thus, the tea leaves purchased by the consumer are not consumed in that form. They are used to make drinkable tea, which is consumed. Similarly, most of the items that enter our kitchen are transformed through the process of cooking. But cooking at home is not an economic activity, even though the product involved undergoes transformation. Home-cooked food is not sold to the market. However, if the same cooking or tea brewing was done in a restaurant where the cooked product would be sold to customers, then the same items, such as tea leaves, would cease to be final goods and would be counted as inputs to which economic value addition can take place. Thus, it is not in the nature of the good, but in the economic nature of its use that a good becomes a final good. Of the final goods, we can distinguish between consumption goods and capital goods. Goods like food and clothing, and services like recreation that are consumed when purchased by their ultimate consumers are called consumption goods or consumer goods. This also includes services which are consumed, but for convenience we may refer to them as consumer goods. Then there are other goods that are of durable character which are used in the production process. These are tools, implements, and machines. While they make production of other commodities feasible, they themselves don't get transformed in the production process. They are also final goods, yet they are not final goods to be ultimately consumed. Unlike the final goods that we have considered above, they are the crucial backbone of any production process, in aiding and enabling the production to take place. These goods form a part of capital, one of the crucial factors of production in which a productive enterprise has invested, and they continue to enable the production process to go on for continuous cycles of production. These are capital goods, and they gradually undergo wear and tear, and thus are repaired or gradually replaced over time. The stock of capital that an economy possesses is thus preserved, maintained, and renewed partially or wholly over time, and this is of some importance in the discussion that will follow. 11 National Income Accounting. We may note here that some commodities like television sets, automobiles, or home computers, although they are for ultimate consumption, have one characteristic in common with capital goods: they are also durable. That is, they are not extinguished by immediate or even short-period consumption. They have a relatively long life as compared to articles such as food or even clothing. They also undergo wear and tear with gradual use and often need repairs and replacements of parts, i.e., like machines, they also need to be preserved, maintained, and renewed. That is why we call these goods consumer durables. Thus, if we consider all the final goods and services produced in an economy in a given period of time, they are either in the form of consumption goods, both durable and non-durable, or capital goods. As final goods, they do not undergo any further transformation in the economic process. Of the total production taking place in the economy, a large number of products don't end up in final consumption and are not capital goods either. Such goods may be used by other producers as material inputs. Examples are steel sheets used for making automobiles and copper used for making utensils. These are intermediate goods mostly used as raw material or inputs for production of other commodities. These are not final goods. Now, to have a comprehensive idea of the total flow of production in the economy, we need to have a quantitative measure of the aggregate level of final goods produced in the economy. However, in order to get a quantitative assessment, a measure of the total final goods and services produced in the economy, it is obvious that we need a common measuring rod. We cannot add meters of cloth produced to tons of rice or number of automobiles or machines. Our common measuring rod is money. Since each of these commodities is produced for sale, the sum total of the monetary value of these diverse commodities gives us a measure of final output. But why are we to measure final goods only? Surely intermediate goods are crucial inputs to any production process, and a significant part of our manpower and capital stock are engaged in production of these goods. However, since we are dealing with value of output, we should realize that the value of the final goods already includes the value of the intermediate goods that have entered into their production as inputs. Counting them separately will lead to the error of double counting. Whereas considering intermediate goods may give a fuller description of total economic activity, counting them will highly exaggerate the final value of our economic activity. At this stage, it is important to introduce the concepts of stocks and flows. Often we hear statements like the average salary of someone is 10,000 rupees, or the output of the steel industry is so many tons or so many rupees in value. But these are incomplete statements because it is not clear whether the income which is being referred to is yearly or monthly or daily income, and surely that makes a huge difference. Sometimes when the context is familiar, we assume that the time period is known and therefore do not mention it. But inherent in all such statements is a definite period of time. Otherwise, such statements are meaningless. Thus, income or output or profits are concepts that make sense only when a time period is specified. These are called flows because they occur in a period of time. Therefore, we need to delineate a time period to get a quantitative measure of these. Since a lot of accounting is done annually in an economy, many of these are expressed annually, like annual profits or production. Flows are defined over a period of time. 12 Introductory Macroeconomics. In contrast, capital goods or consumer durables once produced do not wear out or get consumed in a delineated time period. In fact, capital goods continue to serve us through different cycles of production. The buildings or machines in a factory are there irrespective of the specific time period. There can be addition to or deduction from these if a new machine is added or a machine falls in disuse and is not replaced. These are called stocks. Stocks are defined at a particular point of time. However, we can measure a change in stock over a specific period of time, like how many machines were added this year. Such changes in stocks are thus flows, which can be measured over specific time periods. A particular machine can be part of the capital stock for many years unless it wears out, but that machine can be part of the flow of new machines added to the capital stock only for a single year when it was initially installed. To further understand the difference between stock variables and flow variables, let us take the following example. Suppose a tank is being filled with water coming from a tap. The amount of water which is flowing into the tank from the tap per minute is a flow. But how much water there is in the tank at a particular point of time is a stock concept. To come back to our discussion on the measure of final output, that part of our final output that comprises of capital goods constitutes gross investment of an economy. These may be machines, tools and implements, buildings, office spaces, storehouses, or infrastructure like roads, bridges, airports, or jetties. But all the capital goods produced in a year do not constitute an addition to the capital stock already existing. A significant part of current output of capital goods goes in maintaining or replacing part of the existing stock of capital goods. This is because the already existing capital stock suffers wear and tear and needs maintenance and replacement. A part of the capital goods produced this year goes for replacement of existing capital goods and is not an addition to the stock of capital goods already existing, and its value needs to be subtracted from gross investment for arriving at the measure for net investment. This deletion, which is made from the value of gross investment in order to accommodate regular wear and tear of capital, is called depreciation. So new addition to capital stock in an economy is measured by net investment or new capital formation, which is expressed as net investment equals gross investment, depreciation. Let us examine this concept called depreciation a little more in detail. Let us consider a new machine that a firm invests in. This machine may be in service for the next 20 years, after which it falls into disrepair and needs to be replaced. We can now imagine as if the machine is being gradually used up in each year's production process, and each year 1/20th of its original value is getting depreciated. So, instead of considering a bulk investment for replacement after 20 years, we consider an annual depreciation cost every year. This is the usual sense in which the term depreciation is used, and inherent in its conception is the expected life of a particular capital good, like 20 years in our example of the machine. Depreciation is thus an annual allowance for wear and tear of a. This is how economists define investment. This must not be confused with the commonplace notion of investment, which implies using money to buy physical or financial assets. Thus, use of the term investment to denote purchase of shares or property or even having an insurance policy has nothing to do with how economists define investment. Investment for us is always capital formation, a gross or net addition to capital stock. 13 National Income Accounting. Capital good. In other words, it is the cost of the good divided by number of years of its useful life. Notice here that depreciation is an accounting concept. No real expenditure may have actually been incurred each year, yet depreciation is annually accounted for. In an economy with thousands of enterprises with widely varying periods of life of their equipment, in any particular year, some enterprises are actually making the bulk replacement spending. Thus, we can realistically assume that there will be a steady flow of actual replacement spending which will more or less match the amount of annual depreciation being accounted for in that economy. Now, if we go back to our discussion of total final output produced in an economy, we see that there is output of consumer goods and services and output of capital goods. The consumer goods sustain the consumption of the entire population of the economy. Purchase of consumer goods depends on the capacity of the people to spend on these goods, which, in turn, depends on their income. The other part of the final goods, the capital goods, are purchased by business enterprises. They are used either for maintenance of the capital stock because they're wear and tear of it, or they are used for addition to their capital stock. In a specific time period, say in a year, the total production of final goods can thus be either in the form of consumption or investment. This implies that there is a trade-off. If an economy produces more of consumer goods, it is producing less of capital goods and vice versa. It is generally observed that more sophisticated and heavy capital goods raise the ability of a laborer to produce goods. The traditional weaver would take months to weave a sari, but with modern machinery, thousands of pieces of clothing are produced in a day. Decades were taken to construct the great historical monuments like the pyramids or the Taj Mahal, but with modern construction machinery, one can build a skyscraper in a few years. More production of newer varieties of capital goods, therefore, would help in the greater production of consumer goods. But aren't we contradicting ourselves? Earlier we have seen how, of the total output of final goods of an economy, if a larger share goes for production of capital goods, a smaller share is available for production of consumer goods. And now we are saving more capital goods would mean more consumer goods. There is no contradiction here, however. What is important here is the element of time. At a particular period, given a level of total output of the economy, it is true if more capital goods are produced, less of consumer goods would be produced. But production of more capital goods would mean that in future the laborers would have more capital equipments to work with. We have seen that this leads to a higher capacity of the economy to produce with the same number of laborers. Thus, total input itself would be higher compared to the case when less capital goods were produced. If total output is higher, the amount of consumer goods that can be produced would surely be higher. Depreciation does not take into account unexpected or sudden destruction or disuse of capital, as can happen with accidents, natural calamities, or other such extraneous circumstances. We are making a rather simple assumption here that there is a constant rate of depreciation based on the original value of the asset. There can be other methods to calculate depreciation in actual practice. 14 Introductory Macroeconomics. Thus, the economic cycle not only rolls on, higher production of capital goods enables the economy to expand. It is possible to find another view of the circular flow in the discussion we have made so far. Since we are dealing with all goods and services that are produced for the market, the crucial factor enabling such sale is demand for such products backed by purchasing power. One must have the necessary ability to purchase commodities. Otherwise, one's need for commodities does not get recognized by the market. We have already discussed above that one's ability to buy commodities comes from the income one earns as laborer earning wages, or as entrepreneur earning profits, or as landlord earning rents, or as owner of capital earning interests. In short, the incomes that people earn as owners of factors of production are used by them to meet their demand for goods and services. So we can see a circular flow here which is facilitated through the market. Simply put, the firm's demand for factors of production to run the production process creates payments to the public. In turn, the public's demand for goods and services creates payments to the firms and enables the sale of the products they produce. So the social act of consumption and production are intricately linked, and, in fact, there is a circular causation here. The process of production in an economy generates factor payments for those involved in production and generates goods and services as the outcome of the production process. The incomes so generated create the capacity to purchase the final consumption goods and thus enable their sale by the business enterprises, the basic object of their production. The capital goods which are also generated in the production process also enable their producers to earn income, wages, profits, etc. in a similar manner. The capital goods add to or maintain the capital stock of an economy and thus make production of other commodities possible. 2.2 CF Flow of income methods. See National I. The description of the economy in the previous section enables us to have a rough idea of how a simple economy without a government, external trade, or any savings may function. The households receive their payments from the firms for productive activities they perform for the latter. As we have mentioned before, there may fundamentally be four kinds of contributions that can be made during the production of goods and services. A. Contribution made by human labor, remuneration for which is called wage. B. Contribution made by capital, remuneration for which is called interest. C. Contribution made by entrepreneurship, remuneration of which is profit. D. Contribution made by fixed natural resources called land, remuneration for which is called rent. In this simplified economy, there is only one way in which the households may dispose off their earnings: by spending their entire income on the goods and services produced by the domestic firms. The other channels of disposing their income are closed. We have assumed that the households do not save, they do not pay taxes to the government, since there is no government. And neither do they buy imported goods, since there is no external trade in this simple economy. In other words, factors of production use their remunerations to buy the goods and services which they assisted in producing. The aggregate consumption by the households of the economy is equal to the aggregate expenditure on goods and services produced by the firms in the economy. The 15-15-15-15-15 national income accounting. Entire income of the economy, therefore, comes back to the producers in the form of sales revenue. There is no leakage from the system. There is no difference between the amount that the firms had distributed in the form of factor payments, which is the sum total of remunerations earned by the four factors of production, and the aggregate consumption expenditure that they receive as sales revenue. In the next period, the firms will once again produce goods and services and pay remunerations to the factors of production. These remunerations will once again be used to buy the goods and services. Hence, year after year, we can imagine the aggregate income of the economy going through the two sectors, firms and households, in a circular way. This is represented in Figure 2.1. When the income is being spent on the goods and services produced by the firms, it takes the form of aggregate expenditure received by the firms. Since the value of expenditure must be equal to the value of goods and services, we can equivalently measure the aggregate income by calculating the aggregate value of goods and services produced by the firms. When the aggregate revenue received by the firms is paid out to the factors of production, it takes the form of aggregate income. In Figure 2.1, the uppermost arrow going from the households to the firms represents the spending the households undertake to buy goods and services produced by the firms. The second arrow going from the firms to the households is the counterpart of the arrow above. It stands for the goods and services which are flowing from the firms to the households. In other words, this flow is what the households are getting from the firms for which they are making the expenditures. In short, the two arrows on the top represent the goods and services market. The arrow above represents the flow of payments for the goods and services. The arrow below represents the flow of goods and services. The two arrows at the bottom of the diagram similarly represent the factors of production market. The lowermost arrow going from the households to the firms symbolizes the services that the households are rendering to the firms. Using these services, the firms are manufacturing the output. The arrow above this, going from the firms to the households, represents the payments made by the firms to the households for the services provided by the latter. Since the same amount of money, representing the aggregate value of goods and services, is moving in a circular way, if we want to estimate the aggregate value of goods and services produced during a year, we can measure the annual value of the flows at any of the dotted lines indicated in the diagram. We can measure the uppermost flow at point A by measuring the aggregate value of spending that the firms receive for the final goods and services which they produce. This method will be called the expenditure method. If we measure the flow at B by measuring the aggregate value of final goods and services produced by all. Figure 2.1, Circular Flow of Income in a Simple Economy. 16 Introductory Macroeconomics. The firms, it will be called product method. At C, measuring the sum total of all factor payments will be called income method. Observe that the aggregate spending of the economy must be equal to the aggregate income earned by the factors of production. The flows are equal at A and C. Now let us suppose that at a particular period of time the households decide to spend more on the goods and services produced by the firms. For the time being, let us ignore the question where they would find the money to finance that extra spending. Since they are already spending all of their income, they may have borrowed the money to finance the additional spending. Now if they spend more on the goods and services, the firms will produce more goods and services to meet this extra demand. Since they will produce more, the firms must also pay the factors of production extra remunerations. How much extra amount of money will the firms pay? The additional factor payments must be equal to the value of the additional goods and services that are being produced. Thus, the households will eventually get the extra earnings required to support the initial additional spending that they had undertaken. In other words, the households can decide to spend more, spend beyond their means. And in the end, their income will rise exactly by the amount which is necessary to carry out the extra spending. Putting it differently, an economy may decide to spend more than the present level of income. But by doing so, its income will eventually rise to a level consistent with the higher spending level. This may seem a little paradoxical at first. But since income is moving in a circular fashion, it is not difficult to figure out that a rise in the flow at one point must eventually lead to a rise in the flow at all levels. This is one more example of how the functioning of a single economic agent, say, a household, may differ from the functioning of the economy as a whole. In the former, the spending gets restricted by the individual income of a household. It can never happen that a single worker decides to spend more and this leads to an equivalent rise in her income. We shall spend more time on how higher aggregate spending leads to change in aggregate income in a later chapter. The above-mentioned sketchy illustration of an economy is admittedly a simplified one. Such a story which describes the functioning of an imaginary economy is called a macroeconomic model. It is clear that a model does not describe an actual economy in detail. For example, our model assumes that households do not save, there's no government, no trade with other countries. However, models do not want to capture an economy in its every-minute detail. Their purpose is to highlight some essential features of the functioning of an economic system. But one has to be cautious not to simplify the matters in such a way that misrepresents the essential nature of the economy. The subject of economics is full of models, many of which will be presented in this book. One task of an economist is to figure out which model is applicable to which real-life situation. If we change our simple model described above and introduce savings, will it change the principal conclusion that the aggregate estimate of the income of the economy will remain the same whether we decide to calculate it at A, B, or C? It turns out that this conclusion does not change in a fundamental way. No matter how complicated an economic system may be, the annual production of goods and services estimated through each of the three methods is the same. We have seen that the aggregate value of goods and services produced in an economy can be calculated by three methods. We now discuss the detailed steps of these calculations. 17 National Income Accounting. 2.2.1 The product or value added method. In product method, we calculate the aggregate annual value of goods and services produced if a year is the unit of time. How to go about doing this? Do we add up the value of all goods and services produced by all the firms in an economy? The following example will help us to understand. Let us suppose that there are only two kinds of producers in the economy. They are the wheat producers or the farmers and the bread makers, the bakers. The wheat producers grow wheat and they do not need any input other than human labor. They sell a part of the wheat to the bakers. The bakers do not need any other raw materials besides wheat to produce bread. Let us suppose that in a year the total value of wheat that the farmers have produced is 100 rupees. Out of this they have sold 50 rupees worth of wheat to the bakers. The bakers have used this amount of wheat completely during the year and have produced 200 rupees worth of bread. What is the value of total production in the economy? If we follow the simple way of aggregating the values of production of the sectors, we would add 200 rupees value of production of the bakers to 100 rupees value of production of farmers. The result will be 300 rupees. A little reflection will tell us that the value of aggregate production is not Rs. 300. The farmers had produced 100 rupees worth of wheat for which it did not need assistance of any inputs. Therefore, the entire 100 rupees is rightfully the contribution of the farmers. But the same is not true for the bakers. The bakers had to buy Rs. 50 worth of wheat to produce their bread. The 200 rupees worth of bread that they have produced is not entirely their own contribution. To calculate the net contribution of the bakers, we need to subtract the value of the wheat that they have bought from the farmers. If we do not do this, we shall commit the mistake of double counting. This is because 50 rupees worth of wheat will be counted twice. First, it will be counted as part of the output produced by the farmers. Second time, it will be counted as the imputed value of wheat in the bread produced by the bakers. Therefore, the net contribution made by the bakers is 200 rupees to 50 rupees equals 150 rupees. Hence, aggregate value of goods produced by this simple economy is 100 rupees, net contribution by the farmers plus 150 rupees, net contribution by the bakers equals 250 rupees. The term that is used to denote the net contribution made by a firm is called its value added. We have seen that the raw materials that a firm buys from another firm which are completely used up in the process of production are called intermediate goods. Therefore, the value added of a firm is value of production of the firm, value of intermediate goods used by the firm. The value added of a firm is distributed among its four factors of production, namely, labor, capital, entrepreneurship, and land. Therefore, wages, interest, profits, and rents paid out by the firm must add up to the value added of the firm. Value added is a flow variable. We see ANREPRESENTTHEEXAMPLEGIVENABOVEINTERMSOF Table 2.1. Table 2.1 Production, Intermediate Goods and Value Added. 18 Introductory Macroeconomics. Here all the variables are expressed in terms of money. We can think of the market prices of the goods being used to evaluate the different variables listed here. And we can introduce more players in the chain of production in the example and make it more realistic and complicated. For example, the farmer may be using fertilizers or pesticides to produce wheat. The value of these inputs will have to be deducted from the value of output of wheat. Or the bakers may be selling the bread to a restaurant whose value added will have to be calculated by subtracting the value of intermediate goods, bread in this case. We have already introduced the concept of depreciation, which is also known as consumption of fixed capital. Since the capital which is used to carry out production undergoes wear and tear, the producer has to undertake replacement investments to keep the value of capital constant. The replacement investment is same as depreciation of capital. If we include depreciation in value added, then the measure of value added that we obtain is called gross value added. If we deduct the value of depreciation from gross value added, we obtain net value added. Unlike gross value added, net value added does not include wear and tear that capital has undergone. For example, let us say a firm produces 100 rupees worth of goods per year, 20 rupees is the value of intermediate goods used by it during the year, and 10 rupees is the value of capital consumption. The gross value added of the firm will be 100 rupees to 20 rupees equals 80 rupees per year. The net value added will be 100 rupees to 20 rupees, 10 rupees equals 70 rupees per year. It is to be noted that while calculating the value added, we are taking the value of production of firm. But a firm may be unable to sell all of its produce. In such a case, it will have some unsold stock at the end of the year. Conversely, it may so happen that a firm had some initial unsold stock to begin with. During the year that follows, it has produced very little. But it has met the demand in the market by selling from the stock it had at the beginning of the year. How shall we treat these stocks which a firm may intentionally or unintentionally carry with itself? Also, let us remember that a firm buys raw materials from other firms. The part of raw material which gets used up is categorized as an intermediate good. What happens to the part which does not get used up? In economics, the stock of unsold finished goods or semi-finished goods or raw materials which a firm carries from one year to the next is called inventory. Inventory is a stock variable. It may have a value at the beginning of the year, it may have a higher value at the end of the year. In such a case, inventories have increased or accumulated. If the value of inventories is less at the end of the year compared to the beginning of the year, inventories have decreased, decumulated. We can therefore infer that the change of inventories of a firm during a year is identical to production of the firm during the year, sale of the firm during the year. The sign identical to stands for identity. Unlike equality, equal sign and identity always holds irrespective of what variables we have on the left hand and right hand sides of it. For example, we can write 2 plus 2 is identical to 4 because this is always true. But we must write 2 times x equals 4. This is because 2 times x equals to 4 for a particular value of x, namely when x equals 2 and not always. We cannot write 2 times x is identical to 4. Observe that since production of the firm is identical to value added plus intermediate goods used by the firm, we get change of inventories of a firm during a year is identical to value added plus intermediate goods used by the firm. Sale of the firm during a year. For example, let us suppose that a firm had an unsold stock worth of 100 rupees at the beginning of a year. During the year it had produced 1,000 rupees. 1919 national income accounting worth of goods and managed to sell 800 rupees worth of goods. Therefore, the 200 rupees is the difference between production and sales. This 200 rupees worth of goods is the change in inventories. This will add to the 100 rupees worth of inventories the firm started with. Hence the inventories at the end of the year is 100 rupees plus 200 rupees equals 300 rupees. Notice the change in inventories takes place over a period of time. Therefore, it is a flow variable. Inventories are treated as capital. Addition to the stock of capital of a firm is known as investment. Therefore, change in the inventory of a firm is treated as investment. There can be 3 major categories of investment. First is the rise in the value of inventories of a firm over a year, which is treated as investment expenditure undertaken by the firm. The second category of investment is the fixed business investment, which is defined as the addition to the machinery, factory buildings, and equipment employed by the firms. The last category of investment is the residential investment, which refers to the addition of housing facilities. Change in inventories may be planned or unplanned. In case of an unexpected fall in sales, the firm will have unsold stock of goods which it had not anticipated. Hence there will be unplanned accumulation of inventories. In the opposite case, where there is unexpected rise in the sales, there will be unplanned accumulation of inventories. This can be illustrated with the help of the following example. Suppose a firm produces shirts. It starts the year with an inventory of 100 shirts. During the coming year it expects to sell 1,000 shirts. Hence, it produces 1,000 shirts, expecting to keep an inventory of 100 at the end of the year. However, during the year, the sales of shirts turn out to be unexpectedly low. The firm is able to sell only 600 shirts. This means that the firm is left with 400 unsold shirts. The firm ends the year with 400 plus 100 is equal to 500 shirts. The unexpected rise of inventories by 400 will be an example of unplanned accumulation of inventories. If, on the other hand, the sales had been more than 1,000, we would have unplanned accumulation of inventories. For example, if the sales had been 1,050, then not only the production of 1,000 shirts will be sold, the firm will have to sell 50 shirts out of the inventory. This 50 unexpected reduction in inventories is an example of unexpected decumulation of inventories. What can be the examples of planned accumulation or decumulation of inventories? Suppose the firm wants to raise the inventories from 100 shirts to 200 shirts during the year. Expecting sales of 1,000 shirts during the year, as before, the firm produces 1,000 plus 100 is equal to 1,100 shirts. If the sales are actually 1,000 shirts, then the firm indeed ends up with a rise of inventories. The new stock of inventories is 200 shirts, which was indeed planned by the firm. This rise is an example of planned accumulation of inventories. On the other hand, if the firm had wanted to reduce the inventories from 100 to 25, say, then it would produce 1,000 to 75 equals 925 shirts. This is because it plans to sell 75 shirts out of the inventory of 100 shirts it started with, so that the inventory at the end of the year becomes 100 to 75 equals 25 shirts, which the firm wants. If the sales indeed turn out to be 1,000 as expected by the firm will be left with the planned, reduced inventory of 25 shirts. We shall have more to say on the distinction between unplanned and planned change in inventories in the chapters which follow. 2020-2020 Introductory Macroeconomics. The symbol is a notation. It is used to denote summation. Suppose there are 3 students having pocket money of 200 rupees, 250 and 350 respectively. We can say, if a student has pocket money X, then 1, 2, 3, 200, 250, 300 X equals. The total pocket money will be given by 1, 2, 3 X plus. The summation notation given above is useful in writing it in a shorter form. 1, 2, 3 X plus can be written as, which means that there are 3 values of X corresponding to the 3 individuals 1 to 3, and we are referring to the sum of the values of X for individuals 1 to 3. This notation is particularly useful in macroeconomics since we deal with aggregates. For instance, suppose there are 1,000 consumers in the economy having consumption 1 to 1,000. CCC. If we want to compute the aggregate consumption for this economy, we have to add up all these values, which means aggregate consumption for this economy will be given by 1 to 1,000. CCCC equals plus. The summation notation, however, allows us to write it in a much shorter form. Since we are summing up the values of consumption for individual 1 to individual 1,000, where the value of taking cognizance of change of inventories, we may write gross value added of firm, IGVAI, is identical to gross value of the output produced by the firm, I-G value of intermediate goods used by the firm, Z. GVAI is identical to value of sales by the firm, VI, plus value of change in inventories, AI, value of intermediate goods used by the firm, Z. 2.1. Equation 2.1 has been derived by using change in inventories of a firm during a year is identical to production of the firm during the year, sale of the firm during the year. It is worth noting that the sales by the firm includes sales not only to domestic buyers but also to buyers abroad. The latter is termed as exports. It is also to be noted that all the above-mentioned variables are flow variables. Generally, these are measured on an annual basis. Hence, they measure value of the flows per year. Net value added of the firm I is identical to GVI, depreciation of the firm ID. If we sum the gross value added of all the firms of the economy in a year, we get a measure of the value of aggregate amount of goods and services produced by the economy in a year, just as we had done in the wheat bread example. Such an estimate is called gross domestic product, GDP. Thus, GDP is identical to sum total of gross value added of all the firms in the economy. If there are n firms in the economy, each assigned with a serial number from 1 to n, then GDP is identical to sum total of the gross value added of all the firms in the economy. Is identical to GVA plus GVA. Therefore, GDP is identical to 1 NII 2.2. 21 National Income Accounting. 2.2.2 Expenditure Method. An alternative way to calculate the GDP is by looking at the demand side of the products. This method is referred to as the expenditure method. In the farmer-baker example that we have described before, the aggregate value of the output in the economy by expenditure method will be calculated in the following way. In this method, we add the final expenditures that each firm makes. Final expenditure is that part of expenditure which is undertaken not for intermediate purposes. The 50 rupees worth of wheat which the bakers buy from the farmers counts as intermediate goods, hence it does not fall under the category of final expenditure. Therefore, the aggregate value of output of the economy is 200 rupees, final expenditure received by the baker plus 50 rupees, final expenditure received by the farmer, equals 250 rupees per year. Firm I can make the final expenditure on the following accounts. A. The final consumption expenditure on the goods and services produced by the firm. We shall denote this by C. We may note that mostly it is the households which undertake consumption expenditure. There may be exceptions when the firms buy consumables to treat their guests or for their employees. B. The final investment expenditure I incurred by other firms on the capital goods produced by firm I. Observe that unlike the expenditure on intermediate goods, which is not included in the calculation of GDP, expenditure on investments is included. The reason is that investment goods remain with the firm, whereas intermediate goods are consumed in the process of production. C. The expenditure that the government makes on the final goods and services produced by firm I. We shall denote this by G. We may point out that the final expenditure incurred by the government includes both the consumption and investment expenditure. D. The export revenues that firm I earns by selling its goods and services abroad. This will be denoted by X. Thus the sum total of the revenues that the firm I earns is given by RV is identical to sum total of final consumption, investment, government and exports expenditures received by the firm I. Is identical to C plus I plus G plus X. If there are n firms, then summing over n firms we get 1 NIIRV is identical to sum total of final consumption, investment, government and exports expenditures received by all the firms in the economy. Is identical to 1 NIIC plus 1 NIII plus 1 NIIG plus 1 NIIX. 2.3. Let C be the aggregate final consumption expenditure of the entire economy. Notice that a part of C is spent on imports of consumption goods. C. Consumption for the individual I is C, aggregate consumption will be. In general, if we are taking sum of a quantity X over individuals 1 to n, it will be denoted by 22, 22, 22, 22, 22 Introductory Macroeconomics equals 1 NIIC plus C. Let C denote expenditure on the imports of consumption goods. Therefore C denotes that part of aggregate final consumption expenditure that is spent on the domestic firms. Similarly, let I stand for that part of aggregate final investment expenditure that is spent on domestic firms, where I is the value of the aggregate final investment expenditure of the economy, and out of this I is spent on foreign investment goods. Similarly, G stands for that part of aggregate final government expenditure that is spent on the domestic firms, where G is the aggregate expenditure of the government of the economy and G is the part of G which is spent on imports. Therefore, 1 NIIC is identical to sum total of final consumption expenditures received by all the firms in the economy is identical to C. 1 NIII is identical to sum total of final investment expenditures received by all the firms in the economy is identical to I'm. 1 NIIG is identical to sum total of final government expenditures received by all the firms in the economy is identical to G. Substituting these in equation 2.3, we get 1 NIIRV is identical to C plus I plus G plus 1 NIIX is identical to C plus I plus G plus 1 NIIX. C plus I plus G is identical to C plus I plus G plus X M. Here X is identical to 1 NIIX denotes aggregate expenditure by the foreigners on the exports of the economy. M is identical to C plus I plus G is the aggregate imports expenditure incurred by the economy. We know GDP is identical to sum total of all the final expenditure received by the firms in the economy. In other words, GDP is identical to 1 NIIRV is identical to C plus iota plus G plus X M. 2.4. Equation 2.4 expresses GDP according to the expenditure method. It may be noted that out of the 5 variables on the right-hand side, investment expenditure, I, is the most unstable. 2.2.3 Income method. As we mentioned in the beginning, the sum of final expenditures in the economy must be equal to the incomes received by all the factors of production taken together. Final expenditure is the spending on final goods. It does not include spending on intermediate goods. This follows from the simple idea that the revenues earned by all the firms put together must be distributed among the factors of production as salaries, wages, profits, interest earnings, and rents. Let there be M number of households in the economy. Let W be the wages and salaries received by the IEH household in a particular year. Similarly, P in R be the gross profits, interest payments, and rents received by the IEH household in a particular year. Therefore, GDP is given by GDP is identical to 1 MIIW plus 1 MIIP plus 1 MIIN plus 1 MIIR is identical to W plus P plus N plus R. 2.5. Here, 1 MIIW is identical to W, 1 MIIP is identical to P, 1 MIIN is identical to N, 1 MIIR is identical to R. 23 National Income Accounting. Taking equations 2.2, 2.4, and 2.5 together we get GDP is identical to 1 NIIGVA is identical to C plus I plus G plus X. M is identical to W plus P plus N plus R. 2.6. It is to be noted that in identity 2.6 I stands for sum total of both planned and unplanned investments undertaken by the firms. Since the identities 2.2, 2.4, and 2.6 are different expressions of the same variable, namely GDP, we may represent the equivalence by figure 2.2. Now let us look at a numerical example to see how all the three methods of estimating GDP give us the same answer. Example, there are two firms A and B. Suppose A uses no raw material and produces cotton worth 50 rupees. A sells its cotton to firm B, who uses it to produce cloth. B sells the cloth produced to consumers for 200 rupees. 1. GDP in the phase of production or the value-added method. Recall that value-added VA equals sales, intermediate goods thus. VA equals 50, 0 equals 50, VA equals 200, 50 equals 150. Thus, GDP equals VA plus VA equals 200. Table 2.2, distributions of GDPs for firms A and B. Figure 2.2, diagrammatic representation of GDP by the three methods. 2. GDP in the phase of disposition or the expenditure method. Recall that GDP equals sum of final expenditure or expenditures on goods and services for end use. In the above case, final expenditure is expenditure by consumers on cloth. Therefore, GDP equals 200. 3. GDP in the phase of distribution or income method. Let us look at the firms A and B again. Now, of this 50 received by A, the firm gives 20 rupees to the workers as wages and keeps the remaining 30 as its profits. Similarly, B gives 60 as wages and keeps 90 as profits. 24, 24, 24, 24, 24 Introductory Macroeconomics. In this example, we have left out factor payments in the form of rent and interest. But this will not make any difference to the basic result because after paying wages, the remainder of value added by a firm will be distributed between rent, interest, and profits, together called operating surplus. Table 2.3, distributions of factor incomes of firms A and B. Recall that GDP by income method equals sum total of factor incomes, which is equal to total wages received, workers of A and B, and total profits earned by A and B, which is equal to 80 plus 120 is equal to 200. 2.2.4 Factor cost, basic prices and market prices. In India, the most highlighted measure of national income has been the GDP at factor cost. The Central Statistics Office (CSO) of the Government of India has been reporting the GDP at factor cost and at market prices. In its revision in January 2015, the CSO replaced GDP at factor cost with the GVA at basic prices, and the GDP at market prices, which is now called only GDP, is now the most highlighted measure. The idea of GVA has already been discussed. It is the value of total output produced in the economy less the value of intermediate consumption, the output which is used in production of output further and not used in final consumption. Here we discuss the concept of basic prices. The distinction between factor cost, basic prices, and market prices is based on the distinction between net production taxes less production subsidies, and net product taxes less product subsidies. Production taxes and subsidies are paid or received in relation to production and are independent of the volume of production, such as land revenues, stamp and registration fee. Product taxes and subsidies, on the other hand, are paid or received per unit or product, e.g., excise tax, service tax, export and import duties, etc. Factor cost includes only the payment to factors of production. It does not include any tax. In order to arrive at the market prices, we have to add to the factor cost the total indirect taxes less total subsidies. The basic prices lie in between. They include the production taxes less production subsidies, but not product taxes less product subsidies. Therefore, in order to arrive at market prices, we have to add product taxes less product subsidies to the basic prices. As stated above, now the CSO releases GVA at basic prices. Thus, it includes the net production taxes but not net product taxes. In order to arrive at the GDP at market prices, we need to add net product taxes to GVA at basic prices. Thus, GVA at factor costs plus net production taxes equals GVA at basic prices. GVA at basic prices plus net product taxes equals GVA at market prices. Table 2.5 at the end of the chapter gives the figures for GDP at market prices and GVA at basic prices, while Table 2.6 gives the composition of GDP from expenditure side. 25, 25, 25, 25, 25 National Income Accounting. 2.3 SMI. Gross domestic product measures the aggregate production of final goods and services taking place within the domestic economy during a year. But the whole of it may not accrue to the citizens of the country. For example, a citizen of India working in Saudi Arabia may be earning her wage and it will be included in the Saudi Arabian GDP. But legally speaking, she is an Indian. Is there a way to take into account the earnings made by Indians abroad or by the factors of production owned by Indians? When we try to do this, in order to maintain symmetry, we must deduct the earnings of the foreigners who are working within our domestic economy or the payments to the factors of production owned by the foreigners. For example, the profits earned by the Korean-owned Hyundai car factory will have to be subtracted from the GDP of India. The macroeconomic variable which takes into account such additions and subtractions is known as gross national product, GNP. It is, therefore, defined as follows. GNP is identical to GDP plus factor income earned by the domestic factors of production employed in the rest of the world, factor income earned by the factors of production of the rest of the world employed in the domestic economy. Hence, GNP is identical to GDP plus net factor income from abroad. Net factor income from abroad equals factor income earned by the domestic factors of production employed in the rest of the world, factor income earned by the factors of production of the rest of the world employed in the domestic economy. We have already noted that a part of the capital gets consumed during the year due to wear and tear. This wear and tear is called depreciation. Naturally, depreciation does not become part of anybody's income. If we deduct depreciation from GNP, the measure of aggregate income that we obtain is called net national product, NNP. Thus, NNP is identical to GNP depreciation. It is to be noted that all these variables are evaluated at market prices. Through the expression given above, we get the value of NNP evaluated at market prices. But market price includes indirect taxes. When indirect taxes are imposed on goods and services, their prices go up. Indirect taxes accrue to the government. We have to deduct them from NNP evaluated at market prices in order to calculate that part of NNP which actually accrues to the factors of production. Similarly, there may be subsidies granted by the government on the prices of some commodities. In India, petrol is heavily taxed by the government, whereas cooking gas is subsidized. So we need to add subsidies to the NNP evaluated at market prices. The measure that we obtain by doing so is called net national product at factor cost or national income. Thus, NNP at factor cost is identical to national income, NI is identical to NNP at market prices, indirect taxes, subsidies is identical to NNP at market prices, net indirect taxes. Net indirect taxes is identical to indirect taxes, subsidies. The foreigners have a share in your domestic economy. Discuss this in the classroom. 26 Introductory Macroeconomics. We can further subdivide the national income into smaller categories. Let us try to find the expression for the part of NI which is received by households. We shall call this personal income, PI. First, let us note that out of NI, which is earned by the firms and government enterprises, a part of profit is not distributed among the factors of production. This is called undistributed profits, UP. We have to deduct UP from NI to arrive at PI, since UP does not accrue to the households. Similarly, corporate tax, which is imposed on the earnings made by the firms, will also have to be deducted from the NI since it does not accrue to the households. Similarly, corporate tax, which is imposed on the earnings made by the firms, will also have to be deducted from the NI since it does not accrue to the households. On the other hand, the households do receive interest payments from private firms or the government on past loans advanced by them. And households may have to pay interest to the firms and the government as well, in case they had borrowed money from either. So, we have to deduct the net interests paid by the households to the firms and government. The households receive transfer payments from government and firms, pensions, scholarship, prizes, for example, which have to be added to calculate the personal income of the households. Thus, personal income, PI, is identical to NI, undistributed profits, net interest payments made by households, corporate tax plus transfer payments to the households from the government and firms. However, even PI is not the income over which the households have complete say. They have to pay taxes from PI. If we deduct the personal tax payments, income tax, for example, and non-tax payments, such as fines, from PI, we obtain what is known as the personal disposable income. Thus, personal disposable income, PDI, is identical to PI, personal tax payments, non-tax payments. Personal disposable income is the part of the aggregate income which belongs to the households. They may decide to consume a part of it and save the rest. In Figure 2.3, we present a diagrammatic representation of the relations between these major macroeconomic variables. National disposable income and private income. Apart from these categories of aggregate macroeconomic variables, in India, a few other aggregate income categories are also used in national income accounting. A national disposable income equals net national product at market prices plus other current transfers from the rest of the world. The idea behind national disposable income is that it gives an idea of Figure 2.3, diagrammatic representation of the subcategories of aggregate income. NFIA, net factor income from abroad, D, depreciation, ID, indirect taxes, subsidies, UP. Undistributed profits, NIH. Net interest payments by households, CT, corporate taxes, TRH. Transfers received by households, PTP. Personal tax payments, NP. Non-tax payments. 27 National Income Accounting. Table 2.4 Basic National Income Aggregates. Following the System of National Accounts 2008 SNA 2008, given by the United Nations in partnership with some other agencies, countries are now switching to new aggregates. India shifted to these aggregates a few years back. What is the maximum amount of goods and services the domestic economy has at its disposal? Current transfers from the rest of the world include items such as gifts, aids, etc. Private income equals factor income from net domestic product accruing to the private sector plus national debt interest plus net factor income from abroad plus current transfers from government plus other net transfers from the rest of the world. 28 Introductory Macroeconomics. 29 National Income Accounting. 2.4 Nominal and our GDP. One implicit assumption in all this discussion is that the prices of goods and services do not change during the period of our study. If prices change, then there may be difficulties in comparing GDPs. If we measure the GDP of a country in 2 consecutive years and see that the figure for GDP of the latter year is twice that of the previous year, we may conclude that the volume of production of the country has doubled. But it is possible that only prices of all goods and services have doubled between the 2 years, whereas the production has remained constant. Therefore, in order to compare the GDP figures and other macroeconomic variables of different countries or to compare the GDP figures of the same country at different points of time, we cannot rely on GDPs evaluated at current market prices. For comparison, we take the help of real GDP. Real GDP is calculated in a way such that the goods and services are evaluated at some constant set of prices, or constant prices. Since these prices remain fixed, if the real GDP changes, we can be sure that it is the volume of production which is undergoing changes. Nominal GDP, on the other hand, is simply the value of GDP at the current prevailing prices. For example, suppose a country only produces bread. In the year 2000, it had produced 100 units of bread, price was 10 rupees per bread. GDP at current price was 1,000 rupees. In 2001, the same country produced 110 units of bread at price 15 rupees per bread. Therefore, nominal GDP in 2001 was 1,650 rupees, equals 110 times 15 rupees. Real GDP in 2001 calculated at the price of the year 2000 will be called the base year, will be 110 times 10 rupees equals 1,100 rupees. Notice that the ratio of nominal GDP to real GDP gives us an idea of how the prices have moved from the base year, the year whose prices are being used to calculate the real GDP, to the current year. In the calculation of real and nominal GDP of the current year, the volume of production is fixed. Therefore, if these measures differ, it is only due to change in the price level between the base year and the current year. The ratio of nominal to real GDP is a well-known index of prices. This is called GDP deflator. Thus, if GDP stands for nominal GDP and GDP stands for real GDP, then GDP deflator equals GDP. Sometimes the deflator is also denoted in percentage terms. In such a case, deflator equals GDP times 100%. In the previous example, the GDP deflator is 1,651,100 is equal to 1.50. In percentage terms, this is 150%. This implies that the price of bread produced in 2001 was 1.5 times the price in 2000. Which is true because price of bread has indeed gone up from 10 rupees to 15 rupees. Like GDP deflator, we can have GNP deflator as well. There is another way to measure change of prices in an economy which is known as the Consumer Price Index, CPI. This is the index of prices of a given basket of commodities which are bought by the representative consumer. CPI is generally expressed in percentage terms. We have 2 years under consideration. One is the base year, the other is the current year. We calculate the cost of purchase of a given basket of commodities in the base year. We also calculate the cost of purchase of the same basket in the current year. Then we express the latter as a percentage of the former. This gives us the consumer price index of the current year vis-a-vis the base year. For example, let us take an economy which produces 2 goods, rice and cloth. A representative consumer buys 90 kilograms of rice and 5 pieces of cloth in a year. Suppose in the 30 Introductory Macroeconomics. Year 2000, the price of a kg of rice was 10 rupees and a piece of cloth was 100 rupees. So the consumer had to spend a total sum of 10 rupees times 90 equals 900 rupees on rice in 2000. Similarly, She spent 100 rupees times 5 equals 500 rupees per year on cloth. Summation of the two items is 900 rupees plus 500 rupees equals 1,400 rupees. Now suppose the prices of a kg of rice and a piece of cloth has gone up to 15 rupees and 120 rupees in the year 2005. To buy the same quantity of rice and clothes, the representative will have to spend 1,350 rupees and 600 rupees respectively, calculated in a similar way as before. Their sum will be 1,350 rupees plus 600 rupees equals 1,950 rupees. The CPI therefore will be 1,950. 1,400 times 100 is equal to 139.29, approximately. It is worth noting that many commodities have two sets of prices. One is the retail price which the consumer actually pays. The other is the wholesale price, the price at which goods are traded in bulk. These two may differ in value because of the margin kept by traders. Goods which are traded in bulk, such as raw materials or semi-finished goods, are not purchased by ordinary consumers. Like CPI, the index for wholesale prices is called Wholesale Price Index, WPI. In countries like USA, it is referred to as Producer Price Index, PPI. Notice CPI and analogously WPI may differ from GDP deflator because 1. The goods purchased by consumers do not represent all the goods which are produced in a country. GDP deflator takes into account all such goods and services. 2. CPI includes prices of goods consumed by the representative consumer, hence it includes prices of imported goods. GDP deflator does not include prices of imported goods. 3. The weights are constant in CPI, but they differ according to production level of each good in GDP deflator. 2.5 GDPW. Can the GDP of a country be taken as an index of the welfare of the people of that country? If a person has more income, he or she can buy more goods and services and his or her material well-being improves. So it may seem reasonable to treat his or her income level as his or her level of well-being. GDP is the sum total of value of goods and services created within the geographical boundary of a country in a particular year. It gets distributed among the people as incomes, except for retained earnings. So we may be tempted to treat higher level of GDP of a country as an index of greater well-being of the people of that country. To account for price changes, we may take the value of real GDP instead of nominal GDP. But there are at least 3 reasons why this may not be correct. 1. Distribution of GDP. How uniform is it? If the GDP of the country is rising, the welfare may not rise as a consequence. This is because the rise in GDP may be concentrated in the hands of very few individuals or firms. For the rest, the income may in fact have fallen. In such a case, the welfare of the entire country cannot be said to have increased. For example, suppose in year 2000, an imaginary country had 100 individuals each earning 10 rupees. Therefore, the GDP of the country was 1,000 rupees, by income method. In 2001, let us suppose the same country had 90 individuals earning 9 rupees each, and the rest 10 individual earning 20 rupees each. Suppose there had been no change in the prices of goods and services between these two periods. The GDP of the country in the year 2001 was 90 times 9 rupees plus 10 times 20 rupees equals 810 rupees plus 200 rupees equals 1,010 rupees. Observe that 31, 31, 31, 31, 31 national income accounting. Compared to 2000, the GDP of the country in 2001 was higher by 10 rupees. But this has happened when 90% of people of the country have seen a drop in their real income by 10%, from 10 rupees to 9 rupees, whereas only 10% have benefited by a rise in their income by 100%, from 10 rupees to 20 rupees. 90% of the people are worse off though the GDP of the country has gone up. If we relate welfare improvement in the country to the percentage of people who are better off, then surely GDP is not a good index. 2. Non-monetary exchanges. Many activities in an economy are not evaluated in monetary terms. For example, the domestic services women perform at home are not paid for. The exchanges which take place in the informal sector without the help of money are called barter exchanges. In barter exchanges, goods or services are directly exchanged against each other. But since money is not being used here, these exchanges are not registered as part of economic activity. In developing countries where many remote regions are underdeveloped, these kinds of exchanges do take place, but they are generally not counted in the GDPs of these countries. This is a case of underestimation of GDP. Hence, GDP calculated in the standard manner may not give us a clear indication of the productive activity and well-being of a country. 3. Externalities. Externalities refer to the benefits, or harms, a firm or an individual causes to another for which they are not paid, or penalized. Externalities do not have any market in which they can be bought and sold. For example, let us suppose there is an oil refinery which refines crude petroleum and sells it in the market. The output of the refinery is the amount of oil it refines. We can estimate the value added of the refinery by deducting the value of intermediate goods used by the refinery, crude oil in this case, from the value of its output. The value added of the refinery will be counted as part of the GDP of the economy. But in carrying out the production, the refinery may also be polluting the nearby river. This may cause harm to the people who use the water of the river. Hence, their well-being will fall. Pollution may also kill fish or other organisms of the river on which fish survive. As a result, the fishermen of the river may be losing their livelihood. Such harmful effects that the refinery is inflicting on others, for which it will not bear any cost, are called externalities. In this case, the GDP is not taking into account such negative externalities. Therefore, if we take GDP as a measure of welfare of the economy, we shall be overestimating the actual welfare. This was an example of negative externality. There can be cases of positive externalities as well. In SUCHCASES, GDPWILLUNDEREST HEACTUALWELFAREOF the economy. How uniform is the distribution of GDP? It still seems that a majority of the people are poor and a few benefited. 32 Introductory Macroeconomics. At a very fundamental level, the macroeconomy, it refers to the economy that we study in macroeconomics, can be seen as working in a circular way. The firms employ inputs supplied by households and produce goods and services to be sold to households. Households get the remuneration from the firms for the services rendered by them and by goods and services produced by the firms. So we can calculate the aggregate value of goods and services produced in the economy by any of the three methods: A. Measuring the aggregate value of factor payments, income method; B. Measuring the aggregate value of goods and services produced by the firms, product method; C. Measuring the aggregate value of spending received by the firms, expenditure method. In the product method, to avoid double counting, we need to deduct the value of intermediate goods and take into account only the aggregate value of final goods and services. We derive the formulae for calculating the aggregate income of an economy by each of these methods. We also take note that goods can also be bought for making investments, and these add to the productive capacity of the investing firms. There may be different categories of aggregate income depending on whom these are accruing to. We have pointed out the difference between GDP, GNP, NNP at market price, NNP at factor cost, PI and PDI. Since prices of goods and services may vary, we have discussed how to calculate the three important price indices: GDP deflator, CPI, WPI. Finally, we have noted that it may be incorrect to treat GDP as an index of the welfare of the country. Summary. Final goods, consumer durables, intermediate goods flows, net investment, wage, profit, circular flow of income. Expenditure method of calculating national income, macroeconomic model, value added, plan change. In inventories, gross domestic product, GDP, gross national product, GNP. NNP, at factor cost, or national income, NI, net interest payments made by households, transfer payments to the households from the government and firms, personal tax payments, personal disposable income, PDI. Key concepts, EY concepts. 33 National income accounting. 1. What are the four factors of production and what are the remunerations to each of these called? 2. Why should the aggregate final expenditure of an economy be equal to the aggregate factor payments? Explain. 3. Distinguish between stock and flow. Between net investment and capital, which is a stock and which is a flow? Compare net investment and capital with flow of water into a tank. 4. What is the difference between planned and unplanned inventory accumulation? Write down the relation between change in inventories and value added of a firm. 5. Write down the three identities of calculating the GDP of a country by the three methods. Also briefly explain why each of these should give us the same value of GDP. 6. Define budget deficit and trade deficit. The excess of private investment over saving of a country in a particular year was 2,000 rupees crores. The amount of budget deficit was 1,500 rupees crores. What was the volume of trade deficit of that country? 7. Suppose the GDP at market price of a country in a particular year was 1,100 rupees crores. Net factor income from abroad was 100 rupees crores. The value of indirect taxes, subsidies was 150 rupees crores and national income was 850 rupees crores. Calculate the aggregate value of depreciation. 8. Net national product at factor cost of a particular country in a year is 1,900 rupees crores. There are no interest payments made by the households to the firms/government or by the firms/government to the households. The personal disposable income of the households is 1,200 rupees crores. The personal income taxes paid by them is 600 rupees crores and the value of retained earnings of the firms and government is valued at 200 rupees crores. What is the value of transfer payments made by the government and firms to the households? 9. From the following data, calculate personal income and personal disposable income. Rs crore. A. Net domestic product at factor cost 8,000. B. Net factor income from abroad 200. C. Undisbursed profit 1,000. D. Corporate tax 500. E. Interest received by households 1,500. F. Interest paid by households 1,200. G. Transfer income 300. H. Personal tax 500. 10. In a single day, Raju, the barber, collects 500 rupees from haircuts. Over this day, his equipment depreciates in value by 50 rupees. Of the remaining 450 rupees, Raju pays sales tax worth 30 rupees, takes home 200 rupees and retains 220 rupees for improvement and buying of new equipment. He further pays 20 rupees as income tax from his income. Based on this information, complete Raju's contribution to the following measures of income: A. Gross domestic product, B. NNP. Private income, nominal GDP, real GDP, base year GDP, deflator, consumer price index, CPI, wholesale price index, WPI, externalities. Exercises 34 Introductory Macroeconomics. Table 2.5, GDP and GDP for India at constant 2011-12 prices. These are provisional estimates released by the CSO in 2018. Suggested readings. 1. Bhatturi, A. 1990. Macroeconomics, The Dynamics of Commodity Production, pages 1-27, Macmillan India Limited, New Delhi. 2. Branson, W. H. 1992. Macroeconomic Theory and Policy, 3rd edition, pages 15-34, HarperCollins Publishers India Private Ltd., New Delhi. 3. Dornbusch, R. and S. Fisher. 1988. Macroeconomics, 4th edition, pages 29-62, McGraw-Hill, Paris. 4. Mankiw, N. G. 2000. Macroeconomics, 4th edition, pages 15-76, Macmillan Worth Publishers, New York. At market price, C. NNP at factor cost, D. Personal income, E. Personal disposable income. 11. The value of the nominal GNP of an economy was 2,500 rupees crores in a particular year. The value of GNP of that country during the same year, evaluated at the prices of same base year, was 3,000 rupees crores. Calculate the value of the GNP deflator of the year in percentage terms. Has the price level risen between the base year and the year under consideration? 12. Write down some of the limitations of using GDP as an index of welfare of a country. Source: Annual Report, Reserve Bank of India, 2020-21, Handbook of Statistics on Indian Economy. 35 National Income Accounting. Table 2.6, Composition of GDP, Expenditure Side, 2011-12 Prices. Source: Annual Report, Reserve Bank of India, 2020-21, Handbook of Statistics on Indian Economy. Money and banking. 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 Money is the commonly accepted medium of exchange. In an economy which consists of only one individual, there cannot be any exchange of commodities and hence there is no role for money. Even if there is more than one individual but these individuals do not take part in market transactions, example, family living on an isolated island, money has no function for them. However, as soon as there is more than one economic agent who engage themselves in transactions through the market, money becomes an important instrument for facilitating these exchanges. Economic exchanges without the mediation of money are referred to as barter exchanges. However, they presume the rather improbable double coincidence of wants. Consider, for example, an individual who has a surplus of rice which she wishes to exchange for clothing. If she is not lucky enough, she may not be able to find another person who has the diametrically opposite demand for rice with a surplus of clothing to offer in exchange. The search costs may become prohibitive as the number of individuals increases. Thus, to smoothen the transaction, an intermediate good is necessary which is acceptable to both parties. Such a good is called money. The individuals can then sell their produces for money and use this money to purchase the commodities they need. Though facilitation of exchanges is considered to be the principal role of money, it serves other purposes as well. Following are the main functions of money in a modern economy. 3.1 Functions money. As explained above, the first and foremost role of money is that it acts as a medium of exchange. Barter exchanges become extremely difficult in a large economy because of the high costs people would have to incur looking for suitable persons to exchange their surpluses. Money also acts as a convenient unit of account. The value of all goods and services can be expressed in monetary units. When we say that the value of a certain wristwatch is 500 rupees, we mean that the wristwatch can be exchanged for 500 units of money, where a unit of money is rupee in this case. If the price of a pencil is 2 rupees and that of a pen is 10 rupees, we can calculate the relative price of a pen with respect to a pencil, viz. A pen is worth 10 divided by 2 is equal to 5 pencils. The same notion can be used to calculate the value of 37, 37, 37, 37, 37 money and banking. Money itself with respect to other commodities. In the above example, a rupee is worth 1 divided by 2 is equal to 0.5 pencil, or 1 divided by 10 is equal to 0.1 pen. Thus, if prices of all commodities increase in terms of money, i.e., there is a general increase in the price level, the value of money in terms of any commodity must have decreased, in the sense that a unit of money can now purchase less of any commodity. We call it a deterioration in the purchasing power of money. A barter system has other deficiencies. It is difficult to carry forward one's wealth under the barter system. Suppose you have an endowment of rice which you do not wish to consume today entirely. You may regard the stock of surplus rice as an asset which you may wish to consume or even sell off for acquiring other commodities at some future date. But rice is a perishable item and cannot be stored beyond a certain period. Also, holding the stock of rice requires a lot of space. You may have to spend considerable time and resources looking for people with a demand for rice when you wish to exchange your stock for buying other commodities. This problem can be solved if you sell your rice for money. Money is not perishable and its storage costs are also considerably lower. It is also acceptable to anyone at any point of time. Thus, money can act as a store of value for individuals. Wealth can be stored in the form of money for future use. However, to perform this function well, the value of money must be sufficiently stable. A rising price level may erode the purchasing power of money. It may be noted that any asset other than money can also act as a store of value, e.g. gold, landed property, houses, or even bonds, to be introduced shortly. However, they may not be easily convertible to other commodities and do not have universal acceptability. Some countries have made an attempt to move towards an economy which uses less of cash and more of digital transactions. A cashless society describes an economic state whereby financial transactions are not connected with money in the form of physical banknotes or coins, but rather through the transfer of digital information, usually an electronic representation of money between the transacting parties. In India, government has been consistently investing in various reforms for greater financial inclusion. During the last few years, initiatives such as Jan Dhan accounts, Aadhaar-enabled payment systems, e-wallets, National Financial Switch (NFS), and others have strengthened the government resolve to go cashless. Today, financial inclusion is seen as a realistic dream because of mobile and smartphone penetration across the country. 3.2 Demand for money and supply M. 3.2.1 Demand for money. The demand for money tells us what makes people desire a certain amount of money. Since money is required to conduct transactions, the value of transactions will determine the money people will want to keep. The larger is the quantum of transactions to be made, the larger is the quantity of money demanded. Since the quantum of transactions to be made depends on income, it should be clear that a rise in income will lead to rise in demand for money. Also, when people keep their savings in the form of money rather than putting it in a bank which gives them interest, how much money people keep also depends on rate of interest. Specifically, when interest rates go up, people become less interested in holding money, since holding money amounts to holding less of interest-earning deposits and thus less interest received. Therefore, at higher interest rates, money demanded comes down. 38 Introductory Macroeconomics. 3.2.2 Supply of money. In a modern economy, money comprises cash and bank deposits. Depending on what types of bank deposits are being included, there are many measures of money. These are created by a system comprising two types of institutions: central bank of the economy and the commercial banking system. Central bank. Central bank is a very important institution in a modern economy. Almost every country has one central bank. India got its central bank in 1935. Its name is the Reserve Bank of India. Central bank has several important functions. It issues the currency of the country. It controls money supply of the country through various methods like bank rate, open market operations, and variations in reserve ratios. It acts as a banker to the government. It is the custodian of the foreign exchange reserves of the economy. It also acts as a bank to the banking system, which is discussed in detail later. From the point of view of money supply, we need to focus on its function of issuing currency. This currency issued by the central bank can be held by the public or by the commercial banks and is called the high-powered money or reserve money or monetary base, as it acts as a basis for credit creation. Commercial banks. Commercial banks are the other type of institutions which are a part of the money-creating system of the economy. In the following section, we look at the commercial banking system in detail. They accept deposits from the public and lend out part of these funds to those who want to borrow. The interest rate paid by the banks to depositors is lower than the rate charged from the borrowers. This difference between these two types of interest rates, called the spread, is the profit appropriated by the bank. The process of deposit and loan credit creation by banks is explained below. In order to understand this process, let us discuss a story. Once there was a goldsmith named Lala in a village. In this village, people used gold and other precious metals in order to buy goods and services. In other words, these metals were acting as money. People in the village started keeping their gold with Lala for safekeeping. In return for keeping their gold, Lala issued paper receipts to people of the village and charged a small fee from them. Slowly, over time, the paper receipts issued by Lala began to circulate as money. This means that instead of giving gold for purchasing wheat, someone would pay for wheat or shoes or any other good by giving the paper receipts issued by Lala. Thus, the paper receipts started acting as money since everyone in the village accepted these as a medium of exchange. Now, let us suppose that Lala had 100 kgs of gold deposited by different people and he had issued receipts corresponding to 100 kilograms of gold. At this time, Ramu comes to Lala and asks for a loan of 25 kilograms of gold. Can Lala give the loan? The 100 kilograms of gold with him already has claimants. However, Lala could decide that everyone with gold deposits will not come to withdraw their deposits at the same time, and so he may as well give the loan to Ramu and charge him for it. If Lala gives the loan of 25 kilograms of gold, Ramu could also pay Ali with these 25 kilograms of gold, and Ali could keep the 25 kilograms of gold with Lala in return for a paper receipt. In effect, the paper receipts, acting as money, would see the box on the measures of money supply at the end of the chapter, have risen to 125 kilograms now. It seems that Lala has created money out of thin air. The modern banking system works precisely the way Lala behaves in this example. Commercial banks mediate between individuals or firms with excess funds and lend to those who need funds. People with excess funds can keep their funds in the form of deposits in banks, and those who need funds borrow funds in form of home loans, crop loans, etc. People prefer to keep money in banks because banks offer to pay some interest on any deposits made. Also, it may be safer to keep excess funds in a bank rather than at home, just as people in the example above preferred to keep their gold with Lala instead of keeping it home. In the modern context, given checks and debit cards, having a demand deposit makes transactions more convenient and safer even when they do not earn any interest. Imagine having to pay a large amount in cash for purchasing a house. What does the bank do with the funds that have been deposited with it? Assuming that not everyone who has deposited funds with it will ask for their funds back at the same time, the bank can loan these funds to someone who needs the funds at interest. Of course, the bank has to be sure it will get the funds back at the required time. So the bank will typically retain a portion of the funds to repay depositors whenever they demand their funds back and loan the rest. Since banks earn interest from loans they make, any bank would like to lend the maximum possible. However, being able to repay depositors on demand is crucial to the bank's survival. Depositors would keep their funds in a bank only if they are fully confident of getting them back on demand. A bank must, therefore, balance its lending activities so as to ensure that sufficient funds are available to repay any depositor on demand. 3.3 M Creation BS. Banks can create money in a manner similar to that as given in Lala's story. Banks can lend simply because they do not expect all the depositors to withdraw what they have deposited at the same time. When the banks lend to any person, a new deposit is opened in that person's name. Thus, money supply increases to old deposits plus new deposit plus currency. Let us take an example. Assume that there is only one bank in the country. Let us construct a fictional balance sheet for this bank. Balance sheet is a record of assets and liabilities of any firm. Conventionally, the assets of the firm are recorded on the left-hand side and liabilities on the right-hand side. Accounting rules say that both sides of the balance sheet must be equal, or total assets must be equal to the total liabilities. Assets are things a firm owns or what a firm can claim from others. In case of a bank, apart from buildings, furniture, etc., its assets are loans given to public. When the bank gives out loan of 100 rupees to a person, this is the bank's claim on that person for 100 rupees. Another asset that a bank has is reserves. Reserves are deposits which commercial banks keep with the Central Bank, Reserve Bank of India, RBI, and its cash. These reserves are kept partly as cash and partly in the form of financial instruments, bonds and treasury bills issued by the RBI. Reserves are similar to deposits we keep with banks. We keep deposits and these deposits are our assets, they can be withdrawn by us. Similarly, commercial banks like State Bank of India, SBI, keep their deposits with RBI and these are called reserves. Assets equals reserves plus loans. Liabilities for any firm are its debts or what it owes to others. For a bank, the main liability is the deposits which people keep with it. Liabilities equals deposits. 40 Introductory Macroeconomics. The accounting rule states that both sides of the account must balance. Hence, if assets are greater than liabilities, they are recorded on the right-hand side as net worth. Net worth equals assets, liabilities. 3.3.1 Balance sheet of a fictional bank. Let our fictional bank start with deposits, liabilities equal to 100 rupees. This could be because Ms. Fernandez has deposited 100 rupees in the bank. Let this bank deposit the same amount with RBI as reserves. Table 3.1 represents its balance sheet. 3.1 Balance sheet of a bank. If we assume that there is no currency in circulation, then the total money supply in the economy will be equal to 100 rupees. M equals currency plus deposits equals 0 plus 100. M equals currency plus deposits equals 0 plus 100 is equal to 100. 3.3.2 Limits to credit creation and money multiplier. Suppose Mr. Matthew comes to this bank for a loan of 500 rupees. Can our bank give this loan? If it gives the loan and Mr. Matthew deposits the loan amount in the bank itself, the total bank deposits and therefore the total money supply will rise. It seems as though the banks can go on creating as much money as they want. But is there a limit to money or credit creation by banks? Yes, and this is determined by the central bank RBI. The RBI decides a certain percentage of deposits which every bank must keep as reserves. This is done to ensure that no bank is overlending. This is a legal requirement and is binding on the banks. This is called the required reserve ratio or the reserve ratio or cash reserve ratio CRR. Cash reserve ratio CRR equals percentage of deposits which a bank must keep as cash reserves with the bank. Apart from the CRR, banks are also required to keep some reserves in liquid form in the short term. This ratio is called statutory liquidity ratio or SLR. In our fictional example, suppose CRR equals 20%, then with deposits of 100 rupees, our bank will need to keep 20 rupees, 20% of 100, as cash reserves. Only the remaining amount of deposits, i.e. 80 rupees, 100 minus 20 is equal to 80, can be used to give loans. The statutory requirement of the reserve ratio acts as a limit to the amount of credit that banks can create. We can understand this by going back to our fictional example of an economy with one bank. Let us assume that our bank starts with a deposit of 100 rupees made by Leela. The reserve ratio is 20%. Thus our bank has 80 rupees, 100 to 20. 41, 41, 41, 41, 41 money and banking. To lend, and the bank lends out 80 rupees to Jaspal Kaur, which shows up in the bank's deposits in the next round as liabilities, making a total of 180 rupees as deposits. Now our bank is required to keep 20% of 180, i.e. 36 rupees as cash reserves. Recall that our bank had started with 100 rupees as cash. Since it is required to keep only 36 rupees as reserves, it can lend 64 rupees again. 100 minus 36 is equal to 64. The bank lends out 64 rupees to Junaid. This in turn shows up in the bank as deposits. The process keeps repeating itself till all the required reserves become 100 rupees. The required reserves will be 100 rupees only when the total deposits become 500 rupees. This is because for deposits of 500 rupees, cash reserves would have to be 100 rupees. 20% of 500 is equal to 100. The process is illustrated in Table 3.2. Table 3.2, Money Multiplier Process. The first column lists each round. The second column depicts the total deposits with the bank at the beginning of each round. 20% of these deposits need to be deposited with the RBI as required reserves, column 3. What the bank lends in each round gets added to the deposits with the bank in the next round. Column 4 indicates the loans made by the banks. Table 3.3, Balance sheet of the bank. 42, 42, 42, 42, 42 Introductory Macroeconomics. Since the bank is only expected to keep 20% of its deposits as reserves, thus reserves of 100 rupees, 20% of 500 is equal to 100, can support the deposits of 500 rupees. In other words, our bank can give a loan of 400 rupees. Table 3.3 demonstrates its balance sheet. M equals currency plus deposits equals 0 plus 500 is equal to 500. Thus, money supply increases from 100 rupees to 500 rupees. Given a CRR of 20%, the bank cannot give a loan beyond 400 rupees. Hence, requirement of reserves acts as a limit to money creation. In our example, money multiplier. Thus, reserves of 100 rupees create deposits of Rs 5 by 100 equals Rs 500. 3.4 PTOLS to CMS. Reserve Bank is the only institution which can issue currency. When commercial banks need more funds in order to be able to create more credit, they may go to market for such funds or go to the central bank. Central bank provides them funds through various instruments. This role of RBI, that of being ready to lend to banks at all times, is another important function of the central bank, and due to this, central bank is said to be the lender of last resort. The RBI controls the money supply in the economy in various ways. The tools used by the central bank to control money supply can be quantitative or qualitative. Quantitative tools control the extent of money supply by changing the CRR, or bank rate, or open market operations. Qualitative tools include persuasion by the central bank in order to make commercial banks discourage or encourage lending, which is done through moral suasion, margin requirement, etc. It should be evident by now that if the central bank changes the reserve ratio, this would lead to changes in lending by the banks, which, in turn, would impact the deposits and hence the money supply. In the previously discussed example, what would the money multiplier be if the RBI increases the reserve ratio to 25%? Notice that in the previous case, 100 rupees in reserves could support deposits of 400 rupees. But the banking system would now be able to loan 300 rupees only. It would have to call back some loans to meet the increased reserve requirements. Hence, money supply would fall. Another important tool by which the RBI also influences money supply is open market operations. Open market operations refers to buying and selling of bonds issued by the government in the open market. This purchase and sale is entrusted to the central bank on behalf of the government. When RBI buys a government bond in the open market, it pays for it by giving a check. This check increases the total amount of reserves in the economy and thus increases the money supply. Selling of a bond by RBI to private individuals or institutions leads to reduction in quantity of reserves and hence the money supply. There are two types of open market operations, outright and repo. Outright open market operations are permanent in nature. When the central bank buys these securities, thus injecting money into the system, it is without any promise to sell them later. Similarly, when the central bank sells these securities, thus withdrawing money from the system, it is without any promise to buy them. 43, 43, 43, 43, 43 Money and banking. Later. As a result, the injection/absorption of the money is of permanent nature. However, there is another type of operation in which when the central bank buys the security, this agreement of purchase also has specification about date and price of resale of the security. This type of agreement is called a repurchase agreement or repo. The interest rate at which the money is lent in this way is called the repo rate. Similarly, instead of outright sale of securities, the central bank may sell the securities through an agreement which has a specification about the date and price at which it will be repurchased. This type of agreement is called a reverse repurchase agreement or reverse repo. The rate at which the money is withdrawn in this manner is called the reverse repo rate. The Reserve Bank of India conducts repo and reverse repo operations at various maturities, overnight, 7-day, 14-day, etc. This type of operations have now become the main tool of monetary policy of the Reserve Bank of India. The RBI can influence money supply by changing the rate at which it gives loans to the commercial banks. This rate is called the bank rate in India. By increasing the bank rate, loans taken by commercial banks become more expensive. This reduces the reserves held by the commercial bank and hence decreases money supply. A fall in the bank rate can increase the money supply. Box 3.1, Demand and Supply for Money, a detailed discussion. Money is the most liquid of all assets in the sense that it is universally acceptable and hence can be exchanged for other commodities very easily. On the other hand, it has an opportunity cost. If, instead of holding on to a certain cash balance, you put the money in a fixed deposits in some bank, you can earn interest on that money. While deciding on how much money to hold at a certain point of time, one has to consider the trade-off between the advantage of liquidity and the disadvantage of the foregone interest. Demand for money balance is thus often referred to as liquidity preference. People desire to hold money balance broadly from two motives. The transaction motive. The principal motive for holding money is to carry out transactions. If you receive your income weekly and pay your bills on the first day of every week, you need not hold any cash balance throughout the rest of the week. You may as well ask your employer to deduct your expenses directly from your weekly salary and deposit the balance in your bank account. But our expenditure patterns do not normally match our receipts. People earn incomes at discrete points in time and spend it continuously throughout the interval. Suppose you earn 100 rupees on the first day of every month and run down this balance evenly over the rest of the month. Thus your cash balance at the beginning and end of the month are 100 rupees and 0 respectively. Your average cash holding can then be calculated as 100 rupees plus 0 rupees divided by 2 equals 50 rupees, with which you are making transactions worth 100 rupees per month. Hence your average transaction demand for money is equal to half your monthly income, or, in other words, half the value of your monthly transactions. Consider next a two-person economy consisting of two entities, a firm, owned by one person, and a worker. The firm pays the worker a salary of 100 rupees at the beginning of every month. The worker, in turn, 44, 44, 44, 44, 44 Introductory Macroeconomics, spends this income over the month on the output produced by the firm, the only good available in this economy. Thus, at the beginning of each month, the worker has a money balance of 100 rupees and the firm a balance of 0 rupees. On the last day of the month, the picture is reversed. The firm has gathered a balance of 100 rupees through its sales to the worker. The average money holding of the firm as well as the worker is equal to 50 rupees each. Thus, the total transaction demand for money in this economy is equal to 100 rupees. The total volume of monthly transactions in this economy is 200 rupees. The firm has sold its output worth 100 rupees to the worker, and the latter has sold her services worth 100 rupees to the firm. The transaction demand for money of the economy is again a fraction of the total volume of transactions in the economy over the unit period of time. In general, therefore, the transaction demand for money in an economy MDT can be written in the following form. MDT equals K.T. 3.1, where T is the total value of nominal transactions in the economy over unit period and K is a positive fraction. The two-person economy described above can be looked at from another angle. You may perhaps find it surprising that the economy uses money balance worth only 100 rupees for making transactions worth 200 rupees per month. The answer to this riddle is simple. Each rupee is changing hands twice a month. On the first day, it is being transferred from the employer's pocket to that of the worker, and sometime during the month, it is passing from the worker's hand to the employer's. The number of times a unit of money changes hands during the unit period is called the velocity of circulation of money. In the above example, it is 2 inverse of half the ratio of money balance and the value of transactions. Thus, in general, we may rewrite equation 3.1 in the following form. 1K. MDT equals T, or V. MDT equals T. 3.2, where V equals 1/K is the velocity of circulation. Note that the term on the right-hand side of the above equation, T, is a flow variable, whereas money demand, MDT, is a stock concept. It refers to the stock of money people are willing to hold at a particular point of time. The velocity of money, V, however, has a time dimension. It refers to the number of times every unit of stock changes hand during a unit period of time, say a month or a year. Thus, the left-hand side, V.MDT, measures the total value of monetary transactions that has been made with this stock in the unit period of time. This is a flow variable and is, therefore, equal to the right-hand side. We are ultimately interested in learning the relationship between the aggregate transaction demand for money of an economy and the nominal GDP in a given year. The total value of annual transactions in an economy includes transactions in all intermediate goods and services and is clearly much greater than the nominal GDP. However, normally, there exists a stable, positive relationship between value of transactions and the nominal GDP. An increase in nominal GDP implies an increase in the total value of transactions, and hence a greater transaction demand for money from equation 3.1. Thus, in general, equation 3.1 can be modified in the following way. MDT equals KPY. 3.3, where Y is the real GDP and P is the general price level or the GDP deflator. The above equation tells us that transaction demand for money is positively related to the real income of an economy and also to its average price level. The speculative motive. An individual may hold her wealth in the form of landed property, bullion, bonds, money, etc. For simplicity, let us club all forms of assets other than money together into a single category called bonds. Typically, bonds are papers bearing the promise of a future stream of monetary returns over a certain period of time. These papers are issued by governments or firms for borrowing money from the public, and they are tradable in the market. Consider the following two-period bond. A firm wishes to raise a loan of 100 rupees from the public. It issues a bond that assures 10 rupees at the end of the first year and 10 rupees plus the principal of 100 rupees at the end of the second year. Such a bond is said to have a face value of 100 rupees, a maturity period of 2 years, and a coupon rate of 10%. Assume that the rate of interest prevailing in your savings bank account is equal to 5%. Naturally, you would like to compare the earning from this bond with the interest earning of your savings bank account. The exact question that you would ask is as follows. How much money, if kept in my savings bank account, will generate 10 rupees at the end of 1 year? Let this amount be X. Therefore, X, 1 plus 5, 100, equals 10. In other words, X equals 10, 1, 5, 100, plus. This amount, RSX, is called the present value of 10 rupees discounted at the market rate of interest. Similarly, let Y be the amount of money which, if kept in the savings bank account, will generate 110 rupees at the end of 2 years. Thus, the present value of the stream of returns from the bond should be equal to PV equals X plus Y equals 10, 1, 5, 100, plus 10, 100, 1, 5, 102 plus. Calculation reveals that it is 109.29 rupees, approximate. It means that if you put 109.29 rupees in your savings bank account, it will fetch the same return as the bond. But the seller of the bond is offering the same at a face value of only 100 rupees. Clearly the bond is more attractive than the savings bank account and people will rush to get hold of the bond. Competitive bidding will raise the price of the bond above its face value, till price of the bond is equal to its PV. If price rises above the PV, the bond becomes less attractive compared to the savings bank account and people would like to get rid of it. The bond will be in excess supply and there will be downward pressure on the bond price which will bring it back to the PV. It is clear that under competitive assets market condition, the price of a bond must always be equal to its present value in equilibrium. Now consider an increase in the market rate of interest from 5% to 6%. The present value and hence the price of the same bond will become 46, 46, 46, 46, 46. Introductory Macroeconomics. 2, 10, 100, 10, 6, 6, 1, 1, 100, 100 plus equals 107.33, approximate. It follows that the price of a bond is inversely related to the market rate of interest. Different people have different expectations regarding the future movements in the market rate of interest based on their private information regarding the economy. If you think that the market rate of interest should eventually settle down to 8% per annum, then you may consider the current rate of 5% too low to be sustainable over time. You expect interest rate to rise and consequently bond prices to fall. If you are a bondholder, a decrease in bond price means a loss to you, similar to a loss you would suffer if the value of a property held by you suddenly depreciates in the market. Such a loss occurring from a falling bond price is called a capital loss to the bondholder. Under such circumstances, you will try to sell your bond and hold money instead. Thus, speculations regarding future movements in interest rate and bond prices give rise to the speculative demand for money. When the interest rate is very high, everyone expects it to fall in future and hence anticipates capital gains from bondholding. Hence, people convert their money into bonds. Thus, speculative demand for money is low. When interest rate comes down, more and more people expect it to rise in the future and anticipate capital loss. Thus, they convert their bonds into money, giving rise to a high speculative demand for money. Hence, speculative demand for money is inversely related to the rate of interest. Assuming a simple form, the speculative demand for money can be written as MDS equals max min RRR. 3.4. Where R is the market rate of interest and R are the upper and lower limits of R, both positive constants. It is evident from the above equation that as R decreases from R to R, the value of MDS increases from 0 to infinity. As mentioned earlier, interest rate can be thought of as an opportunity cost or price of holding money balance. If supply of money in the economy increases and people purchase bonds with this extra money, demand for bonds will go up, bond prices will rise and rate of interest will decline. In other words, with an increased supply of money in the economy, the price you have to pay for holding money balance, viz., the rate of interest, should. Figure 3.1. The speculative demand for money. 47, 47, 47, 47, 47. Money and banking. Come down. However, if the market rate of interest is already low enough so that everybody expects it to rise in future, causing capital losses, nobody will wish to hold bonds. Everyone in the economy will hold their wealth in money balance, and if additional money is injected within the economy, it will be used up to satiate people's craving for money balances without increasing the demand for bonds and without further lowering the rate of interest below the floor R. Such a situation is called a liquidity trap. The speculative money demand function is infinitely elastic here. In Figure 3.1, the speculative demand for money is plotted on the horizontal axis and the rate of interest on the vertical axis. When R equals R, speculative demand for money is 0. The rate of interest is so high that everyone expects it to fall in future and hence is sure about a future capital gain. Thus, everyone has converted the speculative money balance into bonds. When R equals R, the economy is in the liquidity trap. Everyone is sure of a future rise in interest rate and a fall in bond prices. Everyone puts whatever wealth they acquire in the form of money and the speculative demand for money is infinite. Total demand for money in an economy is, therefore, composed of transaction demand and speculative demand. The former is directly proportional to real GDP and price level, whereas the latter is inversely related to the market rate of interest. The aggregate money demand in an economy can be summarized by the following equation. M equals MDT plus MDS or M equals KPY plus RR max min. 3.5. Ts upply of M, VM. In a modern economy, money consists mainly of currency notes and coins issued by the monetary authority of the country. In India, currency notes are issued by the Reserve Bank of India, RBI, which is the monetary authority in India. However, coins are issued by the Government of India. Apart from currency notes and coins, the balance in savings or current account deposits, held by the public in commercial banks, is also considered money since checks drawn on these accounts are used to settle transactions. Such deposits are called demand deposits as they are payable by the bank on demand from the account holder. Other deposits, e.g. fixed deposits, have a fixed period to maturity and are referred to as time deposits. Though a 100-rupee note can be used to obtain commodities worth 100 rupees from a shop, the value of the paper itself is negligible, certainly less than 100 rupees. Similarly, the value of the metal in a 5-rupee coin is probably not worth 5 rupees. Why then do people accept such notes and coins in exchange of goods which are apparently more valuable than these? The value of the currency notes and coins is derived from the guarantee provided by the issuing authority of these items. Every currency note bears on its face a promise from the governor of RBI that if someone produces the note to RBI, or any other commercial bank, RBI will be responsible for. 48 Introductory Macroeconomics. See Appendix 3.2 for an estimate of the variations in M1 and M3 over time, giving the person purchasing power equal to the value printed on the note. The same is also true of coins. Currency notes and coins are therefore called fiat money. They do not have intrinsic value like a gold or silver coin. They are also called legal tenders as they cannot be refused by any citizen of the country for settlement of any kind of transaction. Checks drawn on savings or current accounts, however, can be refused by anyone as a mode of payment. Hence, demand deposits are not legal tenders. Legal definitions: narrow and broad money. Money supply, like money demand, is a stock variable. The total stock of money in circulation among the public at a particular point of time is called money supply. RBI publishes figures for 4 alternative measures of money supply, viz. M1, M2, M3 and M4. They are defined as follows. M1 equals CU plus DD. M2 equals M1 plus savings deposits with post office savings banks. M3 equals M1 plus net time deposits of commercial banks. M4 equals M3 plus total deposits with post office savings organizations, excluding national savings certificates. Where CU is currency, notes plus coins, held by the public, and DD is net demand deposits held by commercial banks. The word net implies that only deposits of the public held by the banks are to be included in money supply. The interbank deposits, which a commercial bank holds in other commercial banks, are not to be regarded as part of money supply. M1 and M2 are known as narrow money. M3 and M4 are known as broad money. These measures are in decreasing order of liquidity. M1 is most liquid and easiest for transactions, whereas M4 is least liquid of all. M3 is the most commonly used measure of money supply. It is also known as aggregate monetary resources. Box number 3.2. Demonetization. Demonetization was a new initiative taken by the Government of India in November 2016 to tackle the problem of corruption, black money, terrorism and circulation of fake currency in the economy. Old currency notes of 500 rupees and 1,000 rupees were no longer legal tender. New currency notes in the denomination of 500 rupees and 2,000 rupees were launched. The public were advised to deposit old currency notes in their bank account till December 31, 2016 without any declaration, and up to March 31, 2017 with the RBI with declaration. Further, to avoid a complete breakdown and cash crunch, Notes government had allowed exchange of 4,000 rupees old currency, to buy new currency per person and per day. Further, till December 12, 2016, old currency notes were acceptable as legal tender at petrol pumps, government hospitals, and for payment of government dues, like taxes, power bills, etc. This move received both appreciation and criticism. There were long queues outside banks and ATM booths. The shortage of currency in circulation had an adverse impact on the economic activities. However, things improved with time and normalcy returned. This move has had positive impact also. It improved tax compliance as a large number of people were bought in the tax ambit. The savings of an individual were channelized into the formal financial system. As a result, banks have more resources at their disposal, which can be used to provide more loans at lower interest rates. It is a demonstration of state's decision to put a curb on black money, showing that tax evasion will no longer be tolerated. Tax evasion will result in financial penalty and social condemnation. Tax compliance will improve and corruption will decrease. Demonetization could also help tax administration in another way, by shifting transactions out of the cash economy into the formal payment system. Households and firms have begun to shift from cash to electronic payment technologies. Exchange of commodities without the mediation of money is called barter exchange. It suffers from lack of double coincidence of wants. Money facilitates exchanges by acting as a commonly acceptable medium of exchange. In a modern economy, people hold money broadly for two motives: transaction motive and speculative motive. Supply of money, on the other hand, consists of currency notes and coins, demand and time deposits held by commercial banks, etc. It is classified as narrow and broad money according to the decreasing order of liquidity. In India, the supply of money is regulated by the Reserve Bank of India, RBI, which acts as the monetary authority of the country. Various actions of the public, the commercial banks of the country, and RBI are responsible for changes in the supply of money in the economy. RBI regulates money supply by controlling the stock of high-powered money, the bank rate and reserve requirements of the commercial banks. It also sterilizes the money supply in the economy against external shocks. Summary 50-50-50-50-50 Introductory Macroeconomics. Barter exchange double coincidence of wants money medium of exchange unit of account store of value bonds rate of interest liquidity trap fiat money legal tender narrow money broad money currency deposit ratio reserve deposit ratio high powered money multiplier lender of last resort open market operation bank rate cash reserve ratio CRR repo rate reverse repo rate KKKK key concepts EY concepts EY concepts EY concepts EY concepts. Suggested readings. 1. Dornbusch, R. and S. Fisher. 1990. Macroeconomics, 5th edition, pages 345 to 427, McGraw-Hill, Paris. 2. Sikdar, S. 2006. Principles of Macroeconomics, pages 77 to 89, Oxford University Press, New Delhi. 1. What is a barter system? What are its drawbacks? 2. What are the main functions of money? How does money overcome the shortcomings of a barter system? 3. What is transaction demand for money? How is it related to the value of transactions over a specified period of time? 4. What are the alternative definitions of money supply in India? 5. What is a legal tender? What is fiat money? 6. What is high-powered money? 7. Explain the functions of a commercial bank. 8. What is money multiplier? What determines the value of this multiplier? 9. What are the instruments of monetary policy of RBI? 10. Do you consider a commercial bank creator of money in the economy? 11. What role of RBI is known as lender of last resort? 51, 51, 51, 51, 51 Money and banking. The sum of an infinite geometric series. We want to find out the sum of an infinite geometric series of the following form. S equals A plus A dot R plus A dot R plus A dot R plus A dot R plus infinity, where A and R are real numbers and 0 are less than 1. To compute the sum, multiply the above equation by R to obtain R dot S equals A dot R plus A dot R plus A dot R plus A dot R n plus 1 plus infinity. Subtract the second equation from the first to get S R dot S equals A or 1 R S equals A, which yields S equals A or 1. In the example used for the derivation of the money multiplier, A equals 1 and R equals 0.4. Hence the value of the infinite series is 1104. Equals 5.3. Appendix 3.1 Appendix 3.1 Appendix 3.1 Appendix 3.1 Appendix 3.1. Source: Handbook of Statistics on Indian Economy, Reserve Bank of India, 2020-21. The difference in values between the two columns is attributable to the time deposits held by commercial banks. Money supply in India. Table 3.4, changes in M1 and M3 over time in crore. Appendix 3.2 Appendix 3.2 Appendix 3.2 Appendix 3.2 Appendix 3.2 52 Introductory Macroeconomics. Changes in the composition of the sources of monetary base over time components of money stock. Table 3.5 Sources of change in monetary base in crore. Source: Handbook of Statistics on Indian Economy, Reserve Bank of India, 2020-21. Chapter 4 Determination of income and 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 employment. We have so far talked about the national income, price level, rate of interest, etc. in an ad hoc manner without investigating the forces that govern their values. The basic objective of macroeconomics is to develop theoretical tools called models capable of describing the processes which determine the values of these variables. Specifically, the models attempt to provide theoretical explanation to questions such as what causes periods of slow growth or recessions in the economy, or increment in the price level, or a rise in unemployment. It is difficult to account for all the variables at the same time. Thus, when we concentrate on the determination of a particular variable, we must hold the values of all other variables constant. This is a stylization typical of almost any theoretical exercise and is called the assumption of ceteris paribus, which literally means other things remaining equal. You can think of the procedure as follows. In order to solve for the values of two variables x and y from two equations, we solve for one variable, say x, in terms of y from one equation first, and then substitute this value into the other equation to obtain the complete solution. We apply the same method in the analysis of the macroeconomic system. In this chapter, we deal with the determination of national income under the assumption of fixed price of final goods and constant rate of interest in the economy. The theoretical model used in this chapter is based on the theory given by John Maynard Keynes. 4.1a Demand and its components. In the chapter on national income accounting, we have come across terms like consumption, investment, or the total output of final goods and services in an economy, GDP. These terms have dual connotations. In Chapter 2, they were used in the accounting sense, denoting actual values of these items as measured by the activities within the economy in a certain year. We call these actual or accounting values ex post measures of these items. These terms, however, can be used with a different connotation. Consumption may denote not what people have actually consumed in a given year, but what they 54 Introductory Macroeconomics had planned to consume during the same period. Similarly, investment can mean the amount a producer plans to add to her inventory. It may be different from what she ends up doing. Suppose the producer plans to add 100 rupees worth goods to her stock by the end of the year. Her planned investment is, therefore, 100 rupees in that year. However, due to an unforeseen upsurge of demand for her goods in the market, the volume of her sales exceeds what she had planned to sell, and to meet this extra demand, she has to sell goods worth 30 rupees from her stock. Therefore, at the end of the year, her inventory goes up by Rs 100 to 30 equals 70 rupees only. Her planned investment is 100 rupees, whereas her actual, or ex post, investment is 70 rupees only. We call the planned values of the variables consumption, investment, or output of final goods their ex ante measures. In simple words, ex ante depicts what has been planned and ex post depicts what has actually happened. In order to understand the determination of income, we need to know the planned values of different components of aggregate demand. Let us look at these components now. 4.1.1 Consumption. The most important determinant of consumption demand is household income. A consumption function describes the relation between consumption and income. The simplest consumption function assumes that consumption changes at a constant rate as income changes. Of course, even if income is zero, some consumption still takes place. Since this level of consumption is independent of income, it is called autonomous consumption. We can describe this function as CC psi equals plus. 4.1. The above equation is called the consumption function. Here C is the consumption expenditure by households. This consists of two components: autonomous consumption and induced consumption, psi. Autonomous consumption is denoted by C and shows the consumption which is independent of income. If consumption takes place even when income is zero, it is because of autonomous consumption. The induced component of consumption, psi, shows the dependence of consumption on income. When income rises by 1 rupee, induced consumption rises by MPC, i.e. C, or the marginal propensity to consume. It may be explained as a rate of change of consumption as income changes. C MPC CY increment equals increment. Now let us look at the value that MPC can take. When income changes, change in consumption, C increment, can never exceed the change in income, Y increment. The maximum value which C can take is 1. On the other hand, consumer may choose not to change consumption even when income has changed. In this case, MPC equals 0. Generally, MPC lies between 0 and 1 inclusive of both values. This means that as income increases, either 55 income determination. The consumers does not increase consumption at all, MPC equals 0, or use entire change in income on consumption, MPC equals 1, or use part of the change in income for changing consumption, 0, MPC 1. Imagine a country India which has a consumption function described by C equals 100 plus 0.8 Y. This indicates that even when India does not have any income, its citizens still consume 100 rupees worth of goods. India's autonomous consumption is 100. Its marginal propensity to consume is 0.8. This means that if income goes up by 100 rupees in India, consumption will go up by 80 rupees. Let us also look at another dimension of this: savings. Savings is that part of income that is not consumed. In other words, SYC equals minus. We define the marginal propensity to save, MPS, as the rate of change in savings as income increases. SMPS SY increment equals increment. Since SYC equals minus 1 YC SYYC YYC increment minus equals increment equals minus increment equals minus. Some definitions. Marginal propensity to consume, MPC, it is the change in consumption per unit change in income. It is denoted by C and is equal to CY increment. Marginal propensity to save, MPS. It is the change in savings per unit change in income. It is denoted by S and is equal to 1C minus. It implies that 1SC plus equals average propensity to consume, APC. It is the consumption per unit of income, i.e. CY. Average propensity to save, APS. It is the savings per unit of income, i.e. SY. 56 Introductory Macroeconomics. 4.1.2 Investment. Investment is defined as addition to the stock of physical capital such as machines, buildings, roads, etc., i.e. anything that adds to the future productive capacity of the economy and changes in the inventory or the stock of finished goods of a producer. Note that investment goods such as machines are also part of the final goods. They are not intermediate goods like raw materials. Machines produced in an economy in a given year are not used up to produce other goods but yield their services over a number of years. Investment decisions by producers, such as whether to buy a new machine, depend to a large extent on the market rate of interest. However, for simplicity, we assume here that firms plan to invest the same amount every year. We can write the ex-ante investment demand as I equals I. 4.2. Where I is a positive constant which represents the autonomous, given, or exogenous investment in the economy in a given year. 4.2 Determination of income T sectorm. In an economy without a government, the ex-ante aggregate demand for final goods is the sum total of the ex-ante consumption expenditure and ex-ante investment expenditure on such goods, viz. AD equals C plus I. Substituting the values of C and I from equations 4.1 and 4.2, aggregate demand for final goods can be written as AD equals C plus I plus C dot Y. If the final goods market is in equilibrium, this can be written as Y equals C plus I plus C dot Y, where Y is the ex-ante, or planned, output of final goods. This equation can be further simplified by adding up the two autonomous terms, C and I, making it Y equals A plus C dot Y. 4.3. Where A equals C plus I is the total autonomous expenditure in the economy. In reality, these two components of autonomous expenditure behave in different ways. C, representing subsistence consumption level of an economy, remains more or less stable over time. However, I has been observed to undergo periodic fluctuations. A word of caution is in order. The term Y on the left-hand side of equation 4.3 represents the ex-ante output or the planned supply of final goods. On the other hand, the expression on the right-hand side denotes ex-ante or planned aggregate demand for final goods in the economy. Ex-ante supply is equal to ex-ante demand only when the final goods market and hence the economy is in equilibrium. Equation 4.3 should not, therefore, be confused with the accounting identity of Chapter 2, which states that the ex-post value of total output must always be equal to the sum total of ex-post consumption and ex-post investment in the economy. If ex-ante demand for final goods falls short of the output of final goods that the producers have planned to produce in a given year, equation 4.3 will not hold. Stocks will be piling up in the warehouses, which we may consider as unintended accumulation of inventories. It should be noted that inventories or stocks refers to that part of output produced which is not sold and therefore remains with the firm. Change in inventory is called 57 income determination. Inventory investment. It can be negative as well as positive. If there is a rise in inventory, it is positive inventory investment, while a depletion of inventory is negative inventory investment. The inventory investment can take place due to two reasons. The firm decides to keep some stocks for various reasons. This is called planned inventory investment. 2. The sales differ from the planned level of sales, in which case the firm has to add to / run down existing inventories. This is called unplanned inventory investment. Thus, even though planned Y is greater than planned C plus I, actual Y will be equal to actual C plus I, with the extra output showing up as unintended accumulation of inventories in the ex-post I on the right-hand side of the accounting identity. At this point, we can introduce a government in this economy. The major economic activities of the government that affect the aggregate demand for final goods and services can be summarized by the fiscal variables tax, T, and government expenditure, G, both autonomous to our analysis. Government, through its expenditure G on final goods and services, adds to the aggregate demand like other firms and households. On the other hand, taxes imposed by the government take a part of the income away from the household, whose disposable income, therefore, becomes Y equals YT. Households spend only a fraction of this disposable income for consumption purpose. Hence, equation 4.3 has to be modified in the following way to incorporate the government. Y equals C plus I plus G plus C YT. Note that G, C.T, like C or I, just adds to the autonomous term A. It does not significantly change the analysis in any qualitative way. We shall, for the sake of simplicity, ignore the government sector for the rest of this chapter. Observe also that without the government imposing indirect taxes and subsidies, the total value of final goods and services produced in the economy, GDP, becomes identically equal to the national income. Henceforth, throughout the rest of the chapter, we shall refer to Y as GDP or national income interchangeably. 4.3 Determination of income in the SR. You would recall that in microeconomic theory, when we analyze the equilibrium of demand and supply in a single market, the demand and supply curves simultaneously determine the equilibrium price and the equilibrium quantity. In macroeconomic theory, we proceed in two steps. At the first stage, we work out a macroeconomic equilibrium taking the price level as fixed. At the second stage, we allow the price level to vary and again analyze macroeconomic equilibrium. What is the justification for taking the price level as fixed? Two reasons can be put forward. At the first stage, we are assuming an economy with unused resources, machineries, buildings, and labors. In such a situation, the law of diminishing returns will not apply, hence additional output can be produced without increasing marginal cost. Accordingly, price level does not vary even if the quantity produced changes too. This is just a simplifying assumption which will be changed later. 4.3.1 Macroeconomic equilibrium with price level fixed. A. Graphical method. As already explained, the consumer's demand can be expressed by the equation CC psi equals plus 5850 850 850 858 Introductory Macroeconomics, where C is autonomous expenditure and C is the marginal propensity to consume. How can this relation be shown as a graph? To answer this question, we will need to recall the intercept form of the linear equation. Y equals A plus BX. Here, the variables are X and Y and there is a linear relation between them. A and B are constants. This equation is depicted in figure 4.1. The constant A is shown as the intercept on the y-axis, I.E, the value of y when x is 0. The constant B is the slope of the line, i.e. tangent theta equals B. Consumption function graphical representation. Using the same logic, the consumption function can be shown as follows. Consumption function, where C equals intercept of the consumption function, C equals slope of consumption function equals tan alpha. Investment function graphical representation. In a two-sector model, there are two sources of final demand. The first is consumption and the second is investment. The investment function was shown as I equals I. Graphically, this is shown as a horizontal line at a height equal to I above the horizontal axis. In this model, I is autonomous, which means it is the same no matter whatever is the level of income. Intercept form of the linear equation. Figure 4.1. Consumption function with intercept C. Investment function with I as autonomous. 59, 59, 59, 59, 59 Income determination. Aggregate demand graphical representation. The aggregate demand function shows the total demand made up of consumption plus investment at each level of income. Graphically, it means the aggregate demand function can be obtained by vertically adding the consumption and investment function. Here, OM equals COJ equals IOL equals CI plus. The aggregate demand function is parallel to the consumption function, i.e., they have the same slope C. It may be noted that this function shows X anti-demand. Supply side of macroeconomic equilibrium. In microeconomic theory, we show the supply curve on a diagram with price on the vertical axis and quantity supplied on horizontal axis. INTHEFIRSTSTAGEOF macroeconomic theory, we are taking the price level as fixed. Here, aggregate supply or the GDP is assumed to smoothly move up or down since they are unused resources of all types available. Whatever is the level of GDP, that much will be supplied and price level has no role to play. This kind of supply situation is shown by a 45 line. Now, the 45 line has the feature that every point on it has the same horizontal and vertical coordinates. Suppose GDP is 1,000 rupees at point A. How much will be supplied? The answer is 1,000 rupees worth of goods. How can that point be shown? The answer is that supply corresponding to point A is at point B, which is obtained at the intersection of the 45 line and the vertical line at A. Equilibrium. Equilibrium is shown graphically by putting X anti-aggregate demand and supply together in a diagram, figure 4.6. The point where X anti-aggregate demand is equal to X anti-aggregate supply will be equilibrium. Thus, aggregate supply curve with 45 line. Figure 4.5. Aggregate demand is obtained by vertically adding the consumption and investment functions. Figure 4.4. 60, 60, 60, 60, 60 Introductory Macroeconomics. 4.3.2 Effect of an autonomous change in aggregate demand on income and output. We have seen that the equilibrium level of income depends on aggregate demand. Thus, if aggregate demand changes, the equilibrium level of income changes. This can happen in any one or combination of the following situations. 1. Change in consumption. This can happen due to I changing. 2. Change in C. 2. Change in investment. We have assumed that investment is autonomous. However, it just means that it does not depend on income. There are a number of variables other than income which can affect investment. One important factor is availability of credit. Easy availability of credit encourages investment. Another factor is interest rate. Interest rate is the cost of investable funds, and at higher interest rates, firms tend to lower investment. Let us now concentrate on change in investment with the help of the following example. Let 40.8 CY equals plus 10I equals. In this case, the equilibrium income obtained by equation y to AD comes out to be 250. Now let investment rise to 20. It can be seen that the new equilibrium will be 300. This can be seen by looking at the graph. This increase in income is due to rise in investment, which is a component of autonomous expenditure here. When autonomous investment increases, the AD line shifts in parallel upwards and assumes the position AD. The value of aggregate demand at 40.810 YCIY equals plus 50.8 YY equals plus 152.51 Y equals minus EQUIL IB or IUMPOINTISEAND. Equilibrium level of income is OY. B. Algebraic method. X anti-aggregate demand equals IC psi plus plus. X anti-aggregate supply equals Y. Equilibrium requires that the plans of suppliers are matched by plans of those who provide final demands in the economy. Thus, in this situation, X anti-aggregate demand equals X anti-aggregate supply. 1 CI psi Y YC CI CI YC plus plus equals minus plus plus equals minus. For point 4. Equilibrium of X anti-aggregate demand and supply. Figure 4.6. 60 160 160 160 160 1 income determination. Output Y*1 is Y*1 F, which is greater than the value of output 0 Y*1 equals Y*1 E by an amount EF. EF measures the amount of excess demand that emerges in the economy as a result of the increase in autonomous expenditure. Thus, E no longer represents the equilibrium. To find the new equilibrium in the final goods market, we must look for the point where the new aggregate demand line, AD, intersects the 45 line. That occurs at point E, which is, therefore, the new equilibrium point. The new equilibrium values of output and aggregate demand are Y*2 and AD*2 respectively. Note that in the new equilibrium, output and aggregate demand have increased by an amount EG equals EG, which is greater than the initial increment in autonomous expenditure, increment I equals EF equals EJ. Thus an initial increment in the autonomous expenditure seems to have a multiplier on the equilibrium values of aggregate demand and output. What causes aggregate demand and output to increase by an amount larger than the size of the initial increment in autonomous expenditure? We discuss it in section 4.3.3. 4.3.3 The multiplier mechanism. It was seen in the previous section that with a change in the autonomous expenditure of 10 units, the change in equilibrium income is equal to 50 units from 250 to 300. We can understand this by looking at the multiplier mechanism, which is explained below. The production of final goods employs factors such as labor, capital, land, and entrepreneurship. In the absence of indirect taxes or subsidies, the total value of the final goods output is distributed among different factors of production: wages to labor, interest to capital, rent to land, etc. Whatever is left over is appropriated by the entrepreneur and is called profit. Thus the sum total of aggregate factor payments in the economy, national income, is equal to the aggregate value of the output of final goods, GDP. In the above example, the value of the extra output, 10, is distributed among various factors as factor payments, and hence the income of the economy goes up by 10. When income increases by 10, consumption expenditure goes up by 0.810, since people spend 0.8 equals MPC, fraction of their additional income on consumption. Hence, in the next round, aggregate demand in the economy goes up by 0.810, and there again emerges an excess demand equal to 0.810. Therefore, in the next production cycle, producers increase their planned output further by 0.810 to restore equilibrium. When this extra output is distributed among factors, the income of the economy goes up by 0.810 and consumption demand increases further by 0.810, once again creating excess demand of the same amount. This process goes on, round after round, with producers increasing their output to clear the excess demand in each round and consumers spending a part of their additional equilibrium output and aggregate demand in the fixed price model. 62 Introductory Macroeconomics. Income from this extra production on consumption items, thereby creating further excess demand in the next round. Let us register the changes in the values of aggregate demand and output at each round in Table 4.1. The last column measures the increments in the value of the output of final goods and hence the income of the economy in each round. The second and third columns measure the increments in total consumption expenditure in the economy and increments in the value of aggregate demand in a similar way. In order to find out the total increase in output of the final goods, we must add up the infinite geometric series in the last column, i.e. 10 plus 0.8, 10 plus 0.8, 10 plus. Infinity equals 10, 1 plus 0.8 plus 0.8 plus. Infinity equals 10, 1 minus 0.8 is equal to 50. Table 4.1, the multiplier mechanism in the final goods market. The increment in equilibrium value of total output thus exceeds the initial increment in autonomous expenditure. The ratio of the total increment in equilibrium value of final goods output to the initial increment in autonomous expenditure is called the investment multiplier of the economy. Recalling that 10 and 0.8 represent the values of increment I equals increment A and MPC, respectively, the expression for the multiplier can be explained as the investment multiplier 111 YCS A increment equals minus increment. 4.5. Where Y increment is the total increment in final goods output and C MPC equals. Observe that the size of the multiplier depends on the value of C. As C becomes larger, the multiplier increases. Paradox of thrift. If all the people of the economy increase the proportion of income they save, i.e. if the MPS of the economy increases, the total value of savings in the economy will not increase, it will either decline or remain unchanged. This result is known as the paradox of thrift, which states that as people become more thrifty they end up saving less or same as before. This result, though sounds apparently impossible, is actually a simple application of the model we have learnt. Let us continue with the example. Suppose at the initial equilibrium of Y equals 250, there is an exogenous or autonomous shift in people's expenditure pattern, they suddenly become more thrifty. This may happen due to a new information regarding an imminent war or some other impending disaster, which makes people more circumspect and conservative about their expenditures. Hence the MPS of the economy increases, or alternatively the MPC decreases from 0.8 to 0.5. At the initial income level of AD*1 equals Y*1 is equal to 250. This sudden decline in MPC will imply a decrease in aggregate consumption spending and hence in aggregate demand, AD equals A plus psi, by an amount equal to 0.8 to 0.5, 250 is equal to 75. This can be regarded as an autonomous reduction in consumption expenditure, to the extent that the change in MPC is occurring from some exogenous cause and is not a consequence of changes in the variables of the model. But as aggregate demand decreases by 75, it falls short of the output Y*1 is equal to 250, and there emerges an excess supply equal to 75 in the economy. Stocks are piling up in warehouses and producers decide to cut the value of production by 75 in the next round to restore equilibrium in the market. But that would mean a reduction in factor payments in the next round and hence a reduction in income by 75. As income decreases, people reduce consumption proportionately, but this time according to the new value of MPC, which is 0.5. Consumption expenditure and hence aggregate demand decreases by 0.575, which creates again an excess supply in the market. In the next round, therefore, producers reduce output further by 0.575. Income of the people decreases accordingly and consumption expenditure and aggregate demand goes down again by 0.575. The process goes on. However, as can be inferred from the dwindling values of the successive round effects, the process is convergent. What is the total decrease in the value of output and aggregate demand? Add up the infinite series 75 plus 0.5, 75 plus 0.5, 75 plus infinity, and the total reduction in output turns out to be 75. 1 minus 0.5 is equal to 150. But that means the new equilibrium output of the economy is only Y*2 is equal to 100. People are now saving S*2 equals Y*2, C*2 equals Y*2, C plus C. Y*2 equals 100, 40 plus 0.5 by 100 equals 10 in aggregate, whereas under the previous equilibrium they were saving S*1 equals Y*1, C*1 equals Y*1, C plus C. Y*1 equals 250, 40 plus 0.8 by 250 equals 10 at the previous MPC, C equals 0.8. Total value of savings in the economy has, therefore, remained unchanged. When it changes, the line shifts upwards or downwards in parallel. When C changes, however, the line swings up or down. An increase in MPS 64, 64, 64, 64, 64 Introductory Macroeconomics, or a decline in MPC reduces the slope of the AD line and it swings downwards. We depict the situation in figure 4.8. At the initial values of the parameters A equals 50 and C equals 0.8, the equilibrium value of the output and aggregate demand from equation 4.4 was Y*1 is equal to 51 minus 0.8 is equal to 250. Under the changed value of the parameter C equals 0.5, the new equilibrium value of output and aggregate demand is y*2 is equal to 51 minus 0.5 is equal to 100. The equilibrium output and aggregate demand have declined by 150. As explained above, this, in turn, implies that there is no change in the total value of savings. Paradox of thrift downward swing of AD line. Figure 4.8. 4.4 SMC. The equilibrium output in the economy also determines the level of employment, given the quantities of other factors of production. Think of a production function at aggregate level. This means that the level of output determined by the equality of Y with AD does not necessarily mean the level of output at which everyone is employed. Full employment level of income is that level of income where all the factors of production are fully employed in the production process. Recall that equilibrium attained at the point of equality of Y and AD by itself does not signify full employment of resources. Equilibrium only means that if left to itself, the level of income in the economy will not change even when there is unemployment in the economy. The equilibrium level of output may be more or less than the full employment level of output. If it is less than the full employment of output, it is due to the fact that demand is not enough to employ all factors of production. This situation is called the situation of deficient demand. It leads to decline in prices in the long run. On the other hand, if the equilibrium level of output is more than the full employment level, it is due to the fact that the demand is more than the level of output produced at full employment level. This situation is called the situation of excess demand. It leads to rise in prices in the long run. 65, 65, 65, 65, 65 Income determination. When, at a particular price level, aggregate demand for final goods equals aggregate supply of final goods, the final goods or product market reaches its equilibrium. Aggregate demand for final goods consists of ex-ante consumption, ex-ante investment, government spending, etc. The rate of increase in ex-ante consumption due to a unit increment in income is called marginal propensity to consume. For simplicity, we assume a constant final goods price and constant rate of interest over short run to determine the level of aggregate demand for final goods in the economy. We also assume that the aggregate supply is perfectly elastic at this price. Under such circumstances, aggregate output is determined solely by the level of aggregate demand. This is known as effective demand principle. An increase-decrease in autonomous spending causes aggregate output of final goods to increase-decrease by a larger amount through the multiplier process. Summary. Key concepts, EY concepts, exercises. Aggregate demand equilibrium ex post marginal propensity to consume unintended changes in inventories parametric shift paradox of thrift. Aggregate supply ex-ante consumption ex-ante investment autonomous change effective demand principle autonomous expenditure multiplier. 1. What is marginal propensity to consume? How is it related to marginal propensity to save? 2. What is the difference between ex-ante investment and ex-post investment? 3. What do you understand by parametric shift of a line? How does a line shift when its I-slope decreases and 2. its intercept increases? 4. What is effective demand? How will you derive the autonomous expenditure multiplier when price of final goods and the rate of interest are given? 5. Measure the level of ex-ante aggregate demand when autonomous investment and consumption expenditure A is 50 rupees crores, and MPS is 0.2 and level of income, Y, is 4,000 rupees crores. State whether the economy is in equilibrium or not. Cite reasons. 6. Explain paradox of thrift. Suggested readings. 1. Dornbusch, R. and S. Fisher. 1990. Macroeconomics, 5th edition, pages 63 to 105. McGraw-Hill, Paris. Chapter 5. Government, TTTT, budget, and the economy. We introduced the government in Chapter 1 as denoting the state. We stated that apart from the private sector, there is the government which plays a very important role. An economy in which there is both the private sector and the government is known as a mixed economy. There are many ways in which the government influences economic life. In this chapter, we will limit ourselves to the functions which are carried on through the government budget. This chapter proceeds as follows. In section 5.1, we present the components of the government budget to bring out the sources of government revenue and avenues of government spending. In section 5.2, we discuss the topic of balanced, surplus, or deficit budget to account for the difference between expenditures and revenue collection. It specifically deals with the meaning of different kinds of budget deficits, their implications, and the measures to contain them. Box 5.1 deals with fiscal policy and a simple description of the multiplier. The role the government plays has implications for its deficits which further affect its debt the government owes. The chapter concludes with an analysis of the debt issue. 5.1g Budget, meaning and its c. There is a constitutional requirement in India, Article 112, to present before the Parliament a statement of estimated receipts and expenditures of the government in respect of every financial year which runs from April 1st to March 31st. This annual financial statement constitutes the main budget document of the government. Although the budget document relates to the receipts and expenditure of the government for a particular financial year, the impact of it will be there in subsequent years. There is a need therefore to have two accounts. Those that relate to the current financial year only are included in the revenue account, also called revenue budget, and those that concern the assets and liabilities of the government into the capital account, also called capital budget. In order to understand the accounts, it is important to first understand the objectives of the government budget. 5.1.1 Objectives of government budget. The government plays a very important role in increasing the welfare of the people. In order to do that, the government intervenes in the economy in the following ways. Allocation function of government budget. Government provides certain goods and services which cannot be provided by the market mechanism, i.e. by exchange between individual consumers and producers. Examples of such goods are national defense, roads, government administration, etc., which are referred to as public goods. To understand why public goods need to be provided by the government, we must understand the difference between private goods such as clothes, cars, food items, etc., and public goods. There are two major differences. 1. The benefits of public goods are available to all and are not only restricted to one particular consumer. For example, if a person eats a chocolate or wears a shirt, these will not be available to others. It is said that this person's consumption stands in rival relationship to the consumption of others. However, if we consider a public park or measures to reduce air pollution, the benefits will be available to all. One person's consumption of a good does not reduce the amount available for consumption for others, and so several people can enjoy the benefits, that is, the consumption of many people is not rivalrous. 2. In case of private goods, anyone who does not pay for the goods can be excluded from enjoying its benefits. If you do not buy a ticket, you will not be allowed to watch a movie at a local cinema hall. However, in case of public goods, there is no feasible way of excluding anyone from enjoying the benefits of the good. That is why public goods are called non-excludable. Even if some users do not pay, it is difficult and sometimes impossible to collect fees for the public good. These non-paying users are known as free riders. Consumers will not voluntarily pay for what they can get for free and for which there is no exclusive title to the property being enjoyed. The link between the producer and consumer which occurs through the payment process is broken, and the government must step in to provide for such goods. There is, however, a difference between public provision and public production. Public provision means that they are financed through the budget and can be used without any direct payment. Public goods may be produced by the government or the private sector. When goods are produced directly by the government, it is called public production. Redistribution function of government budget. From Chapter 2 we know that the total national income of the country goes to either the private sector, that is, firms and households, known as private income, or the government, known as public income. Out of private income, what finally reaches the households is known as personal income, and the amount that can be spent is the personal disposable income. The government sector affects the personal disposable income of households by making transfers and collecting taxes. It is through this that the government can change the distribution of income and bring about a distribution that is considered fair by society. This is the redistribution function. Stabilization function of government budget. The government may need to correct fluctuations in income and employment. The overall level of employment and prices in the economy depends upon the level of aggregate demand, which depends on the spending decisions of millions of private economic agents apart from the government. These decisions, in turn, depend on many factors such as income and credit availability. In any period, the level of demand may not be sufficient for full utilization of labor and other resources of the economy. Since wages and prices do not fall below a level, employment cannot be brought back to the earlier level automatically. The government needs to intervene to raise the aggregate demand. On the other hand, there may be times when demand exceeds available output under conditions of high employment and thus may give rise to inflation. In such situations, restrictive conditions may be needed to reduce demand. The intervention of the government, whether to expand demand or reduce it, constitutes the stabilization function. 5.1.2 Classification of receipts. Revenue receipts. Revenue receipts are those receipts that do not lead to a claim on the government. They are therefore termed non-redeemable. They are divided into tax and non-tax revenues. Tax revenues, an important component of revenue receipts, have for long been divided into direct taxes, personal income tax, and firms' corporation tax, and indirect taxes like excise taxes. Duties levied on goods produced within the country, customs duties, taxes imposed on goods imported into and exported out of India, and service tax. Other direct taxes like wealth tax, gift tax, and estate duty, now abolished, have never brought in large amount of revenue and thus have been referred to as paper taxes. The redistribution objective is sought to be achieved through progressive income taxation, in which higher the income, higher is the tax rate. Firms are taxed on a proportional basis, where the tax rate is a particular proportion of profits. With respect to excise taxes, necessities of life are exempted or taxed at low rates, comforts and semi-luxuries are moderately taxed, and luxuries, tobacco and petroleum products are taxed heavily. Non-tax revenue of the central government mainly consists of interest receipts on account of loans by the central government, dividends and profits on investments made by the government, fees and other receipts for services rendered by the government. Cash grants and aid from foreign countries and international organizations are also included. The estimates of revenue receipts take into account the effects of tax proposals made in the finance bill. Capital receipts: the government also receives money by way of loans or from the sale of its assets. Loans will have to be returned to the agencies from which they have been borrowed. Thus they create liability. Sale of government assets, like sale of shares in public sector undertakings PSUs, which is referred. The India tax system witnessed a dramatic change with the introduction of the GST, goods and services tax, which encompasses both goods and services and was be implemented by the center, 28 states and 7 union territories from July 1, 2017. A finance bill, presented along with the annual financial statement, provides details on the imposition, abolition, remission, alteration or regulation of taxes proposed in the budget. To as PSU disinvestment reduce the total amount of financial assets of the government. All those receipts of the government which create liability or reduce financial assets are termed as capital receipts. When government takes fresh loans, it will mean that in future these loans will have to be returned and interest will have to be paid on these loans. Similarly, when government sells an asset, then it means that in future its earnings from that asset will disappear. Thus, these receipts can be debt-creating or non-debt creating. 5.1.3. Classification of expenditure. Revenue expenditure. Revenue expenditure is expenditure incurred for purposes other than the creation of physical or financial assets of the central government. It relates to those expenses incurred for the normal functioning of the government departments and various services, interest payments on debt incurred by the government, and grants given to state governments and other parties, even though some of the grants may be meant for creation of assets. Budget documents classify total expenditure into plan and non-plan expenditure. This is shown in Item 6 on Table 5.1. Within revenue expenditure, a distinction is made between plan and non-plan. According to this classification, plan revenue expenditure relates to central plan. According to this classification, plan revenue expenditure relates to central plans, the 5-year plans, and central assistance for state and union territory plans. Non-plan expenditure, the more important component of revenue expenditure, covers a vast range of general, economic, and social services of the. A case against this kind of classification has been put forth on the ground that it has led to an increasing tendency to start new schemes/projects neglecting maintenance of existing capacity and service levels. It has also led to the misperception that non-plan expenditure is inherently wasteful, adversely affecting resource allocation to social sectors like education and health, where salary comprises an important element. Chart 1. The components of the government budget. Government. The main items of non-plan expenditure are interest payments, defense services, subsidies, salaries, and pensions. Interest payments on market loans, external loans, and from various reserve funds constitute the single largest component of non-plan revenue expenditure. Defense expenditure is committed expenditure in the sense that given the national security concerns, there exists little scope for drastic reduction. Subsidies are an important policy instrument which aim at increasing welfare. Apart from providing implicit subsidies through underpricing of public goods and services like education and health, the government also extends subsidies explicitly on items such as exports, interest on loans, food, and fertilizers. The amount of subsidies as a percent of GDP was 2.02% in 2014-15 and is 1.7% of GDP in 2015-16. B.E. Capital expenditure. There are expenditures of the government which result in creation of physical or financial assets or reduction in financial liabilities. This includes expenditure on the acquisition of land, building, machinery, equipment, investment in shares, and loans and advances by the central government to state and union territory governments, PSUs, and other parties. Capital expenditure is also categorized as plan and non-plan in the budget documents. Plan capital expenditure, like its revenue counterpart, relates to central plan and central assistance for state and union territory plans. Non-plan capital expenditure covers various general, social, and economic services provided by the government. The budget is not merely a statement of receipts and expenditures. Since independence, with the launching of the 5-year plans, it has also become a significant national policy statement. The budget, it has been argued, reflects and shapes, and is, in turn, shaped by the country's economic life. Along with the budget, 3 policy statements are mandated by the Fiscal Responsibility and Budget Management Act, 2003, FRBMA. The medium-term fiscal policy statement sets a 3-year rolling target for specific fiscal indicators and examines whether revenue expenditure can be financed through revenue receipts on a sustainable basis and how productively capital receipts, including market borrowings, are being utilized. The fiscal policy strategy statement sets the priorities of the government in the fiscal area, examining current policies and justifying any deviation in important fiscal measures. The macroeconomic framework statement assesses the prospects of the economy with respect to the GDP growth rate, fiscal balance of the central government and external balance. 5.2b, S surplus and D budget. The government may spend an amount equal to the revenue it collects. This is known as a balanced budget. If it needs to incur higher expenditure, it will have. Box 5.2 provides a brief account of this legislation and its implication for government. The 2005 to 2006 Indian budget introduced a statement highlighting the gender sensitivities of the budgetary allocations. Gender budgeting is an exercise to translate the stated gender commitments of the government into budgetary commitments, involving special initiatives for empowering women and examination of the utilization of resources allocated for women and the impact of public expenditure and policies of the government on women. The 200607 budget enlarged the earlier statement to raise the amount through taxes in order to keep the budget balanced. When tax collection exceeds the required expenditure, the budget is said to be in surplus. However, the most common feature is the situation when expenditure exceeds revenue. This is when the government runs a budget deficit. 5.2.1 Measures of government deficit. When a government spends more than it collects by way of revenue, it incurs a budget deficit. There are various measures that capture government deficit, and they have their own implications for the economy. Revenue deficit, revenue deficit, revenue deficit, revenue deficit, revenue deficit. The revenue deficit refers to the excess of government's revenue expenditure over revenue receipts. Revenue deficit equals revenue expenditure, revenue receipts. Table 5.1. Receipts and expenditures of the central government, 2020 to 21 PA. Source: Economic Survey, 2020 to 21 Public Sector Undertaking. Item 3 in Table 5.1 shows that revenue deficit in 2020 to 21 was 2.7% of GDP. The revenue deficit includes only such transactions that affect the current income and expenditure of the government. When the government incurs a revenue deficit, it implies that the government is dissaving and is using up the savings of the other sectors of the economy to finance a part of its consumption expenditure. This situation means that the government will have to borrow not only to finance its investment but also its consumption requirements. This will lead to a buildup of stock of debt and interest liabilities and force the government. More formally, it refers to the excess of total expenditure, both revenue and capital, over total receipts, both revenue and capital. From the 1997 to 98 budget, the practice of showing budget deficit has been discontinued in India. Eventually, to cut expenditure. Since a major part of revenue expenditure is committed expenditure, it cannot be reduced. Often the government reduces productive capital expenditure or welfare expenditure. This would mean lower growth and adverse welfare implications. Fiscal deficit, fiscal deficit, fiscal deficit, fiscal deficit, fiscal deficit. Fiscal deficit is the difference between the government's total expenditure and its total receipts excluding borrowing. Gross fiscal deficit equals total expenditure, revenue receipts plus non-debt creating capital receipts. Non-debt creating capital receipts are those receipts which are not borrowings and, therefore, do not give rise to debt. Examples are recovery of loans and the proceeds from the sale of PSUs. From Table 5.1 we can see that non-debt creating capital receipts equals 10% of GDP, obtained by subtracting, borrowing and other liabilities from total capital receipts, 1 plus 4a, plus 4b. The fiscal deficit, therefore turn out to be 3.5% of GDP. The fiscal deficit will have to be financed through borrowing. Thus, it indicates the total borrowing requirements of the government from all sources. From the financing side, gross fiscal deficit equals net borrowing at home plus borrowing from RBI plus borrowing from abroad. Net borrowing at home includes that directly borrowed from the public through debt instruments, for example, the various small savings schemes, and indirectly from commercial banks through statutory liquidity ratio, SLR. The gross fiscal deficit is a key variable in judging the financial health of the public sector and the stability of the economy. From the way gross fiscal deficit is measured as given above, it can be seen that revenue deficit is a part of fiscal deficit. Fiscal deficit equals revenue deficit plus capital expenditure, non-debt creating capital receipts. A large share of revenue deficit in fiscal deficit indicated that a large part of borrowing is being used to meet its consumption expenditure needs rather than investment. Primary deficit, primary deficit, primary deficit, primary deficit, primary deficit. We must note that the borrowing requirement of the government includes interest obligations on accumulated debt. The goal of measuring primary deficit is to focus on present fiscal imbalances. To obtain an estimate of borrowing on account of current expenditures exceeding revenues, we need to calculate what has been called the primary deficit. It is simply the fiscal deficit minus the interest payments. Gross primary deficit equals gross fiscal deficit. Gross primary deficit equals gross fiscal deficit. Net interest liabilities. Net interest liabilities consist of interest payments minus interest receipts by the government on net domestic lending. Box 5.1, Fiscal Policy. One of Keynes's main ideas in the general theory of employment, interest and money was that government fiscal policy should be used to stabilize the level of output and employment. Through changes in its expenditure and taxes, the government attempts to increase output and income and seeks to stabilize the ups and downs in the economy. In the process, fiscal policy creates a surplus when total receipts exceed expenditure, or a deficit budget when total expenditure exceed receipts, rather than a balanced budget when expenditure equals receipts. In what follows, we study the effects of introducing the government sector in our earlier analysis of the determination of income. The government directly affects the level of equilibrium income in two specific ways. Government purchases of goods and services, G, increase aggregate demand, and taxes and transfers affect the relation between income, Y, and disposable income, YD, the income available for consumption and saving with the households. We take taxes first. We assume that the government imposes taxes that do not depend on income, called lump sum taxes, equal to T. We assume throughout the analysis that government makes a constant amount of transfers, TR. The consumption function is now C equals C plus CID equals C plus C YT plus TR. 5.1. Where YD equals disposable income. We note that taxes lower disposable income and consumption. For instance, if one earns 1 rupee lakh and has to pay 10,000 rupees in taxes, she has the same disposable income as someone who earns 90,000 rupees but pays no taxes. The definition of aggregate demand augmented to include the government will be AD equals C plus C, YT plus TR plus I plus G. 5.2. Graphically, we find that the lump sum tax shifts the consumption schedule downward in a parallel way, and hence the aggregate demand curve shifts in a similar fashion. The income determination condition in the product market will be Y equals AD, which can be written as Y equals C plus C, YT plus TR plus I plus G. 5.3. Solving for the equilibrium level of income, we get Y equals 11 CT plus CTR plus I plus G. 5.4. Changes in government expenditure. We consider the effects of increasing government purchases, G, keeping taxes constant. When G exceeds T, the government runs a deficit. Because G is a component of aggregate spending, planned aggregate expenditure will increase. The aggregate demand schedule shifts up to AD. At the initial level of output, demand exceeds supply and firms expand production. The new equilibrium is at E. The multiplier mechanism, described in Chapter 4, is in operation. The government spending multiplier is derived as follows. Suppose G changes to a new level, G plus increment G, and as a result Y changes to a new level asterisk, Y plus increment. The new levels of G and Y can also be put into equation 5.4. How does the fiscal policy try to achieve its basic objectives? So 1 asterisk, 1 YYC CT CTR IGGC plus increment equals minus plus increment minus. 5.4a. Subtracting equation 5.4 from equation 5.4a, we get increment Y equals 11 C increment G. 5.5. Or increment equals increment minus 11 YGC. 5.6. In figure 5.1, government expenditure increases from G to G and causes equilibrium income to increase from Y to Y. Changes in taxes. We find that a cut in taxes increases disposable income, YT, at each level of income. This shifts the aggregate expenditure schedule upwards by a fraction C of the decrease in taxes. This is shown in figure 5.2. From equation 5.3, we can calculate the tax multiplier using the same method as for the government expenditure multiplier. 1 YCTC increment equals minus increment minus. 5.7. The tax multiplier equals YT increment equals C1, C. 5.8. Because a tax cut increase will cause an increase reduction in consumption and output, the tax multiplier is a negative multiplier. Comparing equation 5.6 and 5.8, we find that the tax multiplier is smaller in absolute value compared to the government spending multiplier. This is because an increase in government spending directly affects total spending, whereas taxes enter the multiplier process through their impact on disposable income, which influences household consumption, which is a part of total spending. Thus, with A increment T, reduction in taxes, consumption, and hence total spending increases in the first instance by C increment T. To understand how the two multipliers differ, we consider the following example. Figure 5.2. Effect of a reduction in taxes. Figure 5.1. Effect of higher government expenditure. Example. 5.1. Assume that the marginal propensity to consume is 0.8. The government expenditure multiplier will then be 1 C equals 1 minus 0.8 is equal to 1 0.2 is equal to 5. For an increase in government spending by 100, the equilibrium income will increase by increment equals times minus 1, 500, 5 100, 1 GC. The tax multiplier is given by 1 CC equals 0.81, 0.8 equals 0.80.2 equals minus 4. A tax cut of 100 increment T equals minus 100 will increase equilibrium income by 400. Thus, the equilibrium income increases in this case by less than the amount by which it increased under AG increase. Within the present framework, if we take different values of the marginal propensity to consume and calculate the values of the two multipliers, we find that the tax multiplier is always one less in absolute value than the government expenditure multiplier. This has an interesting implication. If an increase in government spending is matched by an equal increase in taxes so that the budget remains balanced, output will rise by the amount of the increase in government spending. Adding the two policy multipliers gives the balanced budget multiplier equals increment YG equals 1 C plus 1, CC equals 1 to 1, CC equals 1. 5.9. A balanced budget multiplier of unity implies that a 100 increase in G financed by 100 increase in taxes increases income by just 100. This can be seen from example 1 where an increase in G by 100 increases output by 500. A tax increase would reduce income by 400 with the net increase of income equal to 100. The equilibrium income refers to the final income that one arrives at in a period sufficiently long for all the rounds of the multipliers to work themselves out. We find that output increases by exactly the amount of increased G with no induced consumption spending due to increase in taxes. To see why the balanced budget multiplier is 1, we examine the multiplier process. The increase in government spending by a certain amount raises income by that amount directly and then indirectly through the multiplier chain, increasing income by increment Y equals increment G plus C increment G plus C increment G plus equals increment G 1 plus C plus C plus 5.10. But the tax increase only enters the multiplier process when the cut in disposable income reduces consumption by C times the reduction in taxes. Thus the effect on income of the tax increase is given by increment Y equals C increment T plus equals increment T C plus C plus 5.11. The difference between the two gives the net effect on income. Since increment G equals increment T from 5.10 and 5.11, we get increment Y equals increment G, that is, income increases by the amount by which government spending increases, and the balanced budget multiplier is unity. This multiplier can also be derived from equation 5.3 as follows. Why is the poor man crying? Suggest measures to wipe off his tears. Increment Y equals increment G plus C increment Y increment T. Since investment does not change, increment I equals 0. 5.12. Since increment G equals increment T, we have YG increment equals 1 to 1, CC equals 1. 5.13. Case of proportional taxes, a more realistic assumption would be that the government collects a constant fraction, T, of income in the form of taxes so that T equals TI. The consumption function with proportional taxes is given by C equals C plus C, Y, TI, plus TR equals C plus C, 1, T, Y plus C TR. 5.14. We note that proportional taxes not only lower consumption at each level of income, but also lower the slope of the consumption function. The MPC out of income falls to C, 1T. The new aggregate demand schedule, AD, has a larger intercept but is flatter as shown in figure 5.3. Now we have AD equals C plus C, 1, T, Y plus C, TR plus I plus G equals A plus C, 1, T, Y. 5.15, where A equals autonomous expenditure and equals C plus C, TR plus I plus G. Income determination condition in the product market is Y equals AD, which can be written as Y equals A plus C, 1, T, Y. 5.16. Solving for the equilibrium level of income. Y equals 1, 1, 1, ACT. 5.17. So that the multiplier is given by increment YA equals 1, 1, 1 CT. 5.18. Comparing this with the value of the multiplier with lump sum taxes case, we find that the value has become smaller. When income rose as a result of an increase in government spending in the case of lump sum taxes, Figure 5.3. Government and aggregate demand. Proportional taxes make the AD schedule flatter. Increase in government expenditure with proportional taxes. Consumption increased by C times the increase in income. With proportional taxes, consumption will rise by less, CCT equals C1T, times the increase in income. For changes in G, the multiplier will now be given by increment Y equals increment G plus C, 1, T, increment Y. 5.19. Increment Y equals 1, 1, 1, GCT increment. 5.20. The income increases from Y to Y, as shown in figure 5.4. The decrease in taxes works in EFF, ECTLIK, EANINC, REASEINP, ROPEN, SIT, YTOCON, SUMEAS. Shown in figure 5.5. The AD curve shifts up to AD. At the initial level of income, aggregate demand for goods exceeds output because the tax reduction causes increased consumption. The new higher level of income is Y. Example 5.2. In example 5.1, if we take a tax rate of 0.25, we find consumption will now rise by 0.60, C1T, is equal to 0.8 times 0.75, for every unit increase in income instead of the earlier 0.80. Thus, consumption will increase by less than before. The government expenditure multiplier will be 1, 1. 1, CT equals 1, 1 minus 0.6 is equal to 1, 0.4 is equal to 2.5, which is smaller than that obtained with lump sum taxes. If government expenditure rises by 100, output will rise by the multiplier times the rise in government expenditure, that is, by 2.5 times 100 is equal to 250. This is smaller than the increase in output with lump sum taxes. The proportional income tax, thus, acts as an automatic stabilizer shock absorber because it makes disposable income, and thus consumer spending, less sensitive to fluctuations in GDP. When GDP rises, disposable income also rises but by less than the rise in GDP because a part of it is siphoned off as taxes. This helps limit the upward fluctuation in consumption spending. During a recession when GDP falls, disposable income falls less sharply, and consumption does not drop as much as it otherwise would have fallen had the tax liability been fixed. This reduces the fall in aggregate demand and stabilizes the economy. We note that these fiscal policy instruments can be varied to offset the effects of undesirable shifts in investment demand. That is, if investment falls from I to I, government spending can be raised from G to G so that autonomous expenditure, C plus I plus G equals C plus I plus G, and equilibrium income remain the same. This deliberate action to stabilize the economy is often referred to as discretionary fiscal policy to distinguish it from the inherent automatic stabilizing properties of the fiscal system. As discussed earlier, proportional taxes help to stabilize the economy against upward and downward movements. Welfare transfers also help to stabilize income. Figure 5.5. Effects of a reduction in the proportional tax rate. During boom years, when employment is high, tax receipts collected to finance such expenditure increase, exerting a stabilizing pressure on high consumption spending. Conversely, during a slump, these welfare payments help sustain consumption. Further, even the private sector has built-in stabilizers. Corporations maintain their dividends in the face of a change in income in the short run, and households try to maintain their previous living standards. All these work as shock absorbers without the NEEDFORAN, YDECISION, MAKERTOTAKEACTION, THATIS, THEYWORK automatically. The built-in stabilizers, however, reduce only part of the fluctuation in the economy. The rest must be taken care of by deliberate policy initiative. Transfers. We suppose that instead of raising government spending in goods and services, government increases transfer payments, TR. Autonomous spending, A, will increase by C increment TR, so output will rise by less than the amount by which it increases when government expenditure increases because a part of any increase in transfer payments is saved. Using the method used earlier for deriving the government expenditure multiplier and the taxation multiplier, the change in equilibrium income for a change in transfers is given by increment Y equals 1 CC increment TR. 5.21. Or YTR increment equals 1 CC. 5.22. Example. We suppose that the marginal propensity to consume is 0.75 and we have lump sum taxes. The change in equilibrium income when government purchases increase by 20 is given by increment Y equals increment minus 110.75 G is equal to 4 times 20 equals 80. An increase in transfers of 20 will raise equilibrium income by increment Y equals increment 0.751, to 0.75 tr is equal to 3 times 20 equals 60. Thus, we find that income increases by less than it increased with a rise in government purchases. Debt. Budgetary deficits must be financed by either taxation, borrowing, or printing money. Governments have mostly relied on borrowing, giving rise to what is called government debt. The concepts of deficits and debt are closely related. Deficits can be thought of as a flow which add to the stock of debt. If the government continues to borrow year after year, it leads to the accumulation of debt and the government has to pay more and more by way of interest. These interest payments themselves contribute to the debt. Perspectives on the appropriate amount of government debt. There are two interlinked aspects of the issue. One is whether government debt is a burden, and two, the issue of financing the debt. The burden of debt must be discussed keeping in mind that what is true of one small trader's debt may not be true for the government's debt, and one must deal with the whole differently from the part. Unlike any one trader, the government can raise resources through taxation and printing money. BYBORROWING THEGOVERNMENTTRANSFERSTHEBURDENOFREDUCED consumption on future generations. This is because it borrows by issuing bonds to the people living at present but may decide to pay off the bonds some 20 years later by raising taxes. These may be levied on the young population that have just entered the workforce, whose disposable income will go down and hence consumption. Thus, national savings, it was argued, would fall. Also, government borrowing from the people reduces the savings available to the private sector. To the extent that this reduces capital formation and growth, debt acts as a burden on future generations. Traditionally, it has been argued that when a government cuts taxes and runs a budget deficit, consumers respond to their after-tax income by spending more. It is possible that these people are short-sighted and do not understand the implications of budget deficits. They may not realize that at some point in the future, the government will have to raise taxes to pay off the debt and accumulated interest. Even if they comprehend this, they may expect the future taxes to fall not on them but on future generations. A counter-argument is that consumers are forward-looking and will base their spending not only on their current income but also on their expected future income. They will understand that borrowing today means higher taxes in the future. Further, the consumer will be concerned about future generations because they are the children and grandchildren of the present generation, and the family, which is the relevant decision-making unit, continues living. They would increase savings now, which will fully offset the increased government savings so that national savings do not change. This view is called Ricardian equivalence after one of the greatest 19th century economists, David Ricardo, who first argued that in the face of high deficits, people save more. It is called equivalence because it argues that taxation and borrowing are equivalent means of financing expenditure. When the government increases spending by borrowing today, which will be repaid by taxes in the future, it will have the same impact on the economy as an increase in government expenditure that is financed by a tax increase today. It has often been argued that debt does not matter because we owe it to ourselves. This is because although there is a transfer of resources between generations, purchasing power remains within the nation. However, any debt that is owed to foreigners involves a burden since we have to send goods abroad corresponding to the interest payments. Other perspectives on deficits and debt. One of the main criticisms of deficits is that they are inflationary. This is because when government increases spending or cuts taxes, aggregate demand increases. Firms may not be able to produce higher quantities that are being demanded at the ongoing prices. Prices will, therefore, have to rise. However, if there are unutilized resources, output is held back by lack of demand. A high fiscal deficit is accompanied by higher demand and greater output and therefore need not be inflationary. It has been argued that there is a decrease in investment due to a reduction in the amount of savings available to the private sector. This is because if the government decides to borrow from private citizens by issuing bonds to finance its deficits, these bonds will compete with corporate bonds and other financial instruments for the available supply of funds. If some private savers decide to buy bonds, the funds remaining to be invested in private hands will be smaller. Thus, some private borrowers will get crowded out of the financial markets as the government claims an increasing share of the economy's total savings. However, one must note that the economy's flow of savings is not really fixed unless we assume that income cannot be augmented. If government deficits succeed in their goal of raising production, there will be more income and, therefore, more saving. In this case, both government and industry can borrow more. Also, if the government invests in infrastructure, future generations may be better off provided the return on such investments is greater than the rate of interest. The actual debt could be paid off by the growth in output. The debt should not then be considered burdensome. The growth in debt will have to be judged by the growth of the economy as a whole. Deficit reduction. Government deficit can be reduced by an increase in taxes or reduction in expenditure. In India, the government has been trying to increase tax revenue with greater reliance on direct taxes. Indirect taxes are regressive in nature, they impact all income groups equally. There has also been an attempt to raise receipts through the sale of shares in PSUs. However, the major thrust has been towards reduction in government expenditure. This could be achieved through making government activities more efficient through better planning of programs and better administration. A recent study by the Planning Commission has estimated that to transfer 1 rupee to the poor, government spends 3.65 rupees in the form of food subsidy, showing that cash transfers would lead to increase in welfare. The other way is to change the scope of the government by withdrawing from some of the areas where it operated before. Cutting back government programs in vital areas like agriculture, education, health, poverty alleviation, etc. would adversely affect the economy. Governments in many countries run huge deficits, forcing them to eventually put in place self-imposed constraints of not increasing expenditure over predetermined levels. Box 5.2 gives the main features of the FRB May in India. These will have to be examined keeping in view the above factors. We must note that larger deficits do not always signify a more expansionary fiscal policy. The same fiscal measures can give rise to a large or small deficit depending on the state of the economy. For example, if an economy experiences a recession and GDP falls, tax revenues fall because firms and households pay lower taxes when they earn less. This means that the deficit increases in a recession and falls in a boom even with no change in fiscal policy. Performance evaluation of the targeted public distribution system by the Program Evaluation Organization Planning Commission. Public goods automatic stabilizer discretionary fiscal policy Ricardian equivalence. KKKK key concepts EY concepts EY concepts EY concepts EY concepts. 1. Public goods as distinct from private goods are collectively consumed. 2 important features of public goods are they are non-rivalrous in that one person can increase her satisfaction from the good without reducing that obtained by others, and they are non-excludable, and there is no feasible way of excluding anyone from enjoying the benefits of the good. These make it difficult to collect fees for their use, and private enterprise will in general not provide these goods. Hence, they must be provided by the government. 2. The 3 functions of allocation, redistribution, and stabilization operate through the expenditure and receipts of the government. 3. The budget, which gives a statement of the receipts and expenditure of the government, is divided into the revenue budget and capital budget to distinguish between current financial needs and investment in the country's capital stock. 4. The growth of revenue deficit as a percentage of fiscal deficit points to a deterioration in the quality of government expenditure involving lower capital formation. 5. Proportional taxes reduce the autonomous expenditure multiplier because taxes reduce the marginal propensity to consume out of income. 6. Public debt is burdensome if it reduces future growth in output. This has been rescheduled by 1 year to 2009 to 10, primarily on account of a shift in plan priorities in favor of revenue expenditure, intensive programs and schemes. Box 5.2, Fiscal Responsibility and Budget Management Act, 2003, FRB May. In a multi-party parliamentary system, electoral concerns play an important role in determining expenditure policies. A legislative provision, it is argued, that is applicable to all governments, present and future, is likely to be effective in keeping deficits under control. The enactment of the FRB May in August 2003 marked a turning point in fiscal reforms, binding the government through an institutional framework to pursue a prudent fiscal policy. The central government must ensure intergenerational equity and long-term macroeconomic stability by achieving sufficient revenue surplus, removing fiscal obstacles to monetary policy, and effective debt management by limiting deficits and borrowing. The rules under the Act were notified with effect from July 2004. Main features. 1. The Act mandates the central government to take appropriate measures to reduce fiscal deficit to not more than 3% of GDP and to eliminate the revenue deficit by March 31, 2009 and thereafter build up adequate revenue surplus. 2. It requires the reduction in fiscal deficit by 0.3% of GDP each year and the revenue deficit by 0.5%. If this is not achieved through tax revenues, the necessary adjustment has to come from a reduction in expenditure. 3. The actual deficits may exceed the target specified only on grounds of national security or natural calamity or such other exceptional grounds as the central government may specify. 5. The Reserve Bank of India must not subscribe to the primary issues of central government securities from the year 2006 to 2007. 6. Measures to be taken to ensure greater transparency in fiscal operations. 7. The central government to lay before both houses of Parliament 3 statements: medium-term fiscal policy statement, the fiscal policy strategy statement, the macroeconomic framework statement, along with the annual financial statement. 4. The central government shall not borrow from the Reserve Bank of India except by way of advances to meet temporary excess of cash disbursements over cash receipts. 8. Quarterly review of the trends in receipts and expenditure in relation to the budget be placed before both houses of Parliament. The Act applies to the central government. However, 26 states have already enacted fiscal responsibility legislations which have made the rule-based fiscal reform program of the government more broad-based. Although the government has emphasized that the FRB is an important institutional mechanism to ensure fiscal prudence and support macroeconomic balance, there have been fears that welfare expenditure may get reduced to meet the targets mandated by the Act. FRB Review Committee. FRB Review Committee. In the last 13 years since the FRB Act was enacted, the Indian economy has graduated to a middle-income country. At the time of enactment of the FRB, there was a general thinking that fiscal rules were better than discretion. However, since then the advanced countries have moved away from this, but in India the government has affirmed its faith in the fiscal policy principles set out in the FRB. Therefore, there is support for retaining the basic operational framework designed in 2003 but to revamp it to incorporate the changing scenario in India and also with an eye for the future path of growth. The task that has been handed to the FRB Review Committee. Box 5.3, GST, One Nation, One Tax, One Market. Goods and Service Tax, GST, is the single comprehensive indirect tax, operational from July 1, 2017 on supply of goods and services right from the manufacturer/service provider to the consumer. It is a destination-based consumption tax with facility of input tax credit in the supply chain. It is applicable throughout the country with one rate for one type of goods/service. It has amalgamated a large number of central and state taxes and cesses. It has replaced large number of taxes on goods and services levied on production/sale of goods or provision of service. As there have been a number of intermediate goods/services which were manufactured/provided in the economy, the pre-GST tax regime imposed taxes not on the value added at each stage but on the total value of the commodity/service with minimal facility of utilization of input tax credit, ITC. The total value included taxes paid on intermediate goods/services. This amounted to cascading of tax. Under GST, the tax is discharged at every stage of supply and the credit of tax paid at the previous stage is available for set-off at the next stage of supply of goods and/or services. It is thus effectively a tax on value addition at each stage of supply. In view of our large and fast-growing economy, it addresses to establish parity in taxation across the country and extend principles of value-added taxation to all goods and services. It has replaced various types of taxes/cesses levied by the central and state/UT governments. Some of the major taxes that were levied by center were central excise duty, service tax, central sales tax, cesses like KKC and SBC. The major state taxes were VAT/sales tax, entry tax, luxury tax, octroi, entertainment tax, taxes on advertisements, taxes on lottery/betting/gambling, state cesses on goods, etc. These have been subsumed in GST. 5 petroleum products have been kept out of GST for the time being, but with passage of time they will get subsumed in GST. State governments will continue to levy VAT on alcoholic liquor for human consumption. Tobacco and tobacco products will attract both GST and central excise duty. Under GST, there are six standard rates applied, i.e. 0%, 3%, 5%, 12%, 18%, and 28% on supply of all goods and/or services across the country. GST is the biggest tax reform in the country since independence and was rolled out on the midnight of 30 June/1 July 2017 during a special midnight session of the Parliament. The 101 Constitution Amendment Act received assent of the President of India on September 8, 2016. The amendment introduced Article 246A in the Constitution, cross-empowering Parliament and legislatures of states to make laws with reference to goods and service tax imposed by the Union and the states. Thereafter, CGST Act, UTGST Act, and SGST Acts were enacted for GST. GST has simplified the multiplicity of taxes on goods and services. The laws, procedures, and rates of taxes across the country are standardized. It has facilitated the freedom of movement of goods and services and created a common market in the country. It is aimed at reducing the cost of business operations and cascading effect of various taxes on consumers. It has also reduced the overall cost of production, which will make Indian products/services more competitive in the domestic and international markets. It will also result into higher economic growth as GDP is expected to rise by about 2%. Compliance will also be easier as all tax payment-related services like registration, returns, payments are available online through a common portal. It has expanded the tax base, introduced higher transparency in the taxation system, reduced human interface between taxpayer and government, and is furthering ease of doing business. 1. Explain why public goods must be provided by the government. 2. Distinguish between revenue expenditure and capital expenditure. 3. The fiscal deficit gives the borrowing requirement of the government. Elucidate. 4. Give the relationship between the revenue deficit and the fiscal deficit. 5. Suppose that for a particular economy, investment is equal to 200, government purchases are 150, net taxes, that is lump sum taxes minus transfers, is 100 and consumption is given by C equals 100 plus 0.75 y. A. What? Exercises. Suggested readings. 1. Dornbusch, R. and S. Fisher. 1994. Macroeconomics, 6th edition. McGraw-Hill, Paris. 2. Mankiw, Ng, 2000. Macroeconomics, 4th edition. Macmillan Worth Publishers, New York. 3. Economic Survey, Government of India, various issues. Is the level of equilibrium income? B. Calculate the value of the government expenditure multiplier and the tax multiplier. C. If government expenditure increases by 200, find the change in equilibrium income. 6. Consider an economy described by the following functions: C equals 20 plus 0.80 y, I equals 30, G equals 50, TR equals 100, A. Find the equilibrium level of income and the autonomous expenditure multiplier in the model. B. If government expenditure increases by 30, what is the impact on equilibrium income? C. If a lump sum tax of 30 is added to pay for the increase in government purchases, how will equilibrium income change? 7. In the above question, calculate the effect on output of a 10% increase in transfers and a 10% increase in lump sum taxes. Compare the effects of the two. 8. We suppose that C equals 70 plus 0.70 yd, I equals 90, G equals 100, T equals 0.10 y. A. Find the equilibrium income. B. What are tax revenues at equilibrium income? Does the government have a balanced budget? 9. Suppose marginal propensity to consume is 0.75 and there is a 20% proportional income tax. Find the change in equilibrium income for the following: A. Government purchases increase by 20, B. Transfers decrease by 20. 10. Explain why the tax multiplier is smaller in absolute value than the government expenditure multiplier. 11. Explain the relation between government deficit and government debt. 12. Does public debt impose a burden? Explain. 13. Are fiscal deficits inflationary? 14. Discuss the issue of deficit reduction. 15. What do you understand by GST? How good is the system of GST as compared to the old tax system? State its categories. Open economy, open economy, open economy, open economy, open economy, macroeconomics, 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 macroeconomics. An open economy is one which interacts with other countries through various channels. So far we had not considered this aspect and just limited to a closed economy in which there are no linkages with the rest of the world in order to simplify our analysis and explain the basic macroeconomic mechanisms. In reality, most modern economies are open. There are 3 ways in which these linkages are established. 1. Output market. An economy can trade in goods and services with other countries. This widens choice in the sense that consumers and producers can choose between domestic and foreign goods. 2. Financial market. Most often an economy can buy financial assets from other countries. This gives investors the opportunity to choose between domestic and foreign assets. 3. Labor market. Firms can choose where to locate production and workers to choose where to work. There are various immigration laws which restrict the movement of labor between countries. Movement of goods has traditionally been seen as a substitute for the movement of labor. We focus on the first 2 linkages. Thus, an open economy is said to be one that trades with other nations in goods and services and most often also in financial assets. Indians, for instance, can consume products which are produced around the world, and some of the products from India are exported to other countries. Foreign trade, therefore, influences Indian aggregate demand in 2 ways. First, when Indians buy foreign goods, this spending escapes as a leakage from the circular flow of income, decreasing aggregate demand. Second, our exports to foreigners enter as an injection into the circular flow, increasing aggregate demand for goods produced within the domestic economy. When goods move across national borders, money must be used for the transactions. At the international level, there is no single currency that is issued by a single bank. Foreign economic agents will accept a national currency only if they are convinced that the amount of goods they can buy with a certain amount of that currency will not change frequently. In other words, the currency will maintain a stable purchasing power. Without this confidence, a currency will not be used as an international medium of exchange and unit of account, since there is no international authority with the power to force the use of a particular currency in international transactions. In the past, governments have tried to gain confidence of potential users by announcing that the national currency will be freely convertible at a fixed price into another asset. Also, the issuing authority will have no control over the value of that asset into which the currency can be converted. This other asset most often has been gold or other national currencies. There are two aspects of this commitment that has affected its credibility: the ability to convert freely in unlimited amounts and the price at which this conversion takes place. The international monetary system has been set up to handle these issues and ensure stability in international. 87 Open Economy Macroeconomics. Buying foreign goods is expenditure from our country and it becomes the income of that foreign country. Hence, the purchase of foreign goods or imports decreases the domestic demand for goods and services in our country. Similarly, selling of foreign goods or exports brings income to our country and adds to the aggregate domestic demand for goods and services in our country. Figure 6.1 Components of current account. Balance on current account. Current account is in balance when receipts on current account are equal to the payments on the current account. A surplus current account means that the nation is a lender to other countries, and a deficit current account means that the nation is a borrower from other countries. Balance on current account has two components: balance of trade or trade balance, balance on invisibles. Balance of trade, BT, is the difference between the value of exports and value of imports of goods of a country in a given period of time. Export of goods is entered as a credit item in BT, whereas import of goods is entered as a debit item in BT. It is also known as trade balance. BT is said to be in balance when exports of goods are equal to the imports of goods. Surplus BT or trade surplus will arise if country exports more goods than what it imports. Whereas deficit BT or trade deficit will arise if a country imports more goods than what it exports. Net invisibles is the difference between the value of exports and value. 88 Introductory Macroeconomics. Of imports of invisibles of a country in a given period of time. Invisibles include services, transfers, and flows of income that take place between different countries. Services trade includes both factor and non-factor income. Factor income includes net international earnings on factors of production like labor, land, and capital. Non-factor income is net sale of service products like shipping, banking, tourism, software services, etc. 6.1.2 Capital account. Capital account records all international transactions of assets. An asset is any one of the forms in which wealth can be held, for example, money, stocks, bonds, government debt, etc. Purchase of assets is a debit item on the capital account. If an Indian buys a UK car company, it enters capital account transactions as a debit item as foreign exchange is flowing out of India. On the other hand, sale of assets like sale of share of an Indian company to a Chinese customer is a credit item on the capital account. Figure 6.2 classifies the items which are a part of capital account transactions. These items are foreign direct investments, FDIs, foreign institutional investments, FIs, external borrowings, and assistance. Figure 6.2 Components of capital account. Balance on capital account. Capital account is in balance when capital inflows, like receipt of loans from abroad, sale of assets or shares in foreign companies, are equal to capital outflows, like repayment of loans, purchase of assets or shares in foreign countries. Surplus in capital account arises when capital inflows are greater than capital outflows, whereas deficit in capital account arises when capital inflows are lesser than capital outflows. 6.1.3 Balance of payments, surplus and deficit. The essence of international payments is that just like an individual who spends more than her income must finance the difference by selling assets or by borrowing, a country that has a deficit in its current account, spending more. 89 Open Economy Macroeconomics. Then it receives from sales to the rest of the world, must finance it by selling assets or by borrowing abroad. Thus, any current account deficit must be financed by a capital account surplus, that is, a net capital inflow. Current account plus capital account zero is identical to. In this case, in which a country is said to be in balance of payments equilibrium, the current account deficit is financed entirely by international lending without any reserve movements. Alternatively, the country could use its reserves of foreign exchange in order to balance any deficit in its balance of payments. The Reserve Bank sells foreign exchange when there is a deficit. This is called official reserve sale. The increase in official reserves is called the overall balance of payments deficit surplus. The basic premise is that the monetary authorities are the ultimate financiers of any deficit in the balance of payments or the recipients of any surplus. We note that official reserve transactions are more relevant under a regime of fixed exchange rates than when exchange rates are floating. See subheading Fixed Exchange Rates under Section 6.2.2. Autonomous and accommodating transactions. International economic transactions are called autonomous when transactions are made due to some reason other than to bridge the gap in the balance of payments, that is, when they are independent of the state of BOP. One reason could be to earn profit. These items are called above-the-line items in the BOP. The balance of payments is said to be in surplus deficit if autonomous receipts are greater, less than autonomous payments. Accommodating transactions termed below-the-line items, on the other hand, are determined by the gap in the balance of payments, that is, whether there is a deficit or surplus in the balance of payments. In other words, they are determined by the net consequences of the autonomous transactions. Since the official reserve transactions are made to bridge the gap in the BOP, they are seen as the accommodating item in the BOP, all others being autonomous. Errors and omissions. It is difficult to record all international transactions accurately. Thus, we have a third element of BOP apart from the current and capital accounts called errors and omissions, which reflects this. Table 6.1 provides a sample of balance of payments for India. Note in this table there is a trade deficit and current account deficit but a capital account surplus. As a result, BP is in balance. 90-90-90-90-90 Introductory Macroeconomics. Box 6.1, the balance of payments accounts presented above divide the transactions into two accounts, current account and capital account. However, following the new accounting standards introduced by the International Monetary Fund in the 6th edition of the Balance of Payments and International Investment Position Manual (BPM 6), the Reserve Bank of India also made changes in the structure of balance of payments accounts. According to the new classification, the transactions are divided into three accounts: current account, financial account, and capital account. The most important change is that almost all the transactions arising on account of trade in financial assets such as bonds and equity shares are now placed in the financial account. However, RBI continues to publish the balance of payments accounts as per the old system also, therefore the details of the new system are not being given here. The details are given in the Balance of Payments Manual for India published by the Reserve Bank of India in September 2010. Table 6.1, Balance of Payments for India in million USD. 91, 91, 91, 91, 91 Open Economy Macroeconomics. 6.2 TF Exchange Market. So far, we have considered the accounting of international transactions on the whole. We will now take up a single transaction. Let us assume that a single Indian resident wants to visit London on a vacation and import of tourist services. She will have to pay in pounds for her stay there. She will need to know where to obtain the pounds and at what price. As mentioned at the beginning of this chapter, this price is known as the exchange rate. The market in which national currencies are traded for one another is known as the foreign exchange market. The major participants in the foreign exchange market are commercial banks, foreign exchange brokers, and other authorized dealers and monetary authorities. It is important to note that although participants themselves may have their own trading centers, the market itself is worldwide. There is a close and continuous contact between the trading centers and the participants deal in more than one market. 6.2.1 Foreign exchange rate. Foreign exchange rate, also called forex rate, is the price of one currency in terms of another. It links the currencies of different countries and enables comparison of international costs and prices. For example, if we have to pay 50 rupees for $1, then the exchange rate is 50 rupees per dollar. To make it simple, let us consider that India and USA are the only countries in the world, and so there is only one exchange rate that needs to be determined. Demand for foreign exchange. People demand foreign exchange because they want to purchase goods and services from other countries, they want to send gifts abroad, and they want to purchase financial assets of a certain country. A rise in price of foreign exchange will increase the cost, in terms of rupees, of purchasing a foreign good. This reduces demand for imports and hence demand for foreign exchange also decreases, other things remaining constant. Supply of foreign exchange. Foreign currency flows into the home country due to the following reasons. Exports by a country lead to the purchase of its domestic goods and services by the foreigners. Foreigners send gifts or make transfers, and the assets of a home country are bought by the foreigners. A rise in price of foreign exchange will reduce the foreigner's cost, in terms of USD, while purchasing products from India, other things remaining constant. This increases India's exports and hence supply for foreign exchange may. 92 Introductory Macroeconomics. Increase, whether it actually increases depends on a number of factors, particularly elasticity of demand for exports and imports. 6.2.2 Determination of the exchange rate. Different countries have different methods of determining their currency's exchange rate. It can be determined through flexible exchange rate, fixed exchange rate, or managed floating exchange rate. Flexible exchange rate. This exchange rate is determined by the market forces of demand and supply. It is also known as floating exchange rate. As depicted in Figure 6.1, the exchange rate is determined where the demand curve intersects with the supply curve, i.e., at point E on the y-axis. Point Q on the x-axis determines the quantity of US dollars that have been demanded and supplied on the exchange rate. In a completely flexible system, the central banks do not intervene in the foreign exchange market. Suppose the demand for foreign goods and services increases, for example, due to INCREASEDINTE or NATIONAL traveling by Indians. Then as depicted in Figure 6.2, the demand curve shifts upward and right to the original demand curve. The increase in demand for foreign goods and services result in a change in the exchange rate. the initial exchange rate E equals 50, which means that we need to exchange 50 rupees for $1. At the new equilibrium, the exchange rate becomes E equals 70, which means that we need to pay more rupees for $1 now, i.e., 70 rupees. It indicates that the value of rupees in terms of dollars has fallen and value of dollar in terms of rupees has risen. Increase in exchange rate implies that the price of foreign currency, dollar, in terms of domestic currency, rupees, has increased. This is called depreciation of domestic currency, rupees, in terms of foreign currency, dollars. SIMILARLY, INAFLEXIBLE exchange rate regime. When the price of domestic currency, rupees, in terms of foreign currency, dollars, increases, it is called appreciation of the domestic currency, rupees, in TERMSOFFOREIGNCURENCY, dollars. This means that the equilibrium under flexible exchange rates. Figure 6.2. Effect of an increase in demand for imports in the foreign exchange market. Value of rupees relative to dollar has risen and we need to pay fewer rupees in exchange for $1. Speculation. Money in any country is an asset. If Indians believe that British pound is going to increase in value relative to the rupee, they will want to hold pounds. Thus exchange rates also get affected when people hold foreign exchange on the expectation that they can make gains from the appreciation of the currency. This expectation in turn can actually affect the exchange rate in the following way. If the current exchange rate is 80 rupees to a pound and investors believe that the pound is going to appreciate by the end of the month and will be worth 85 rupees, investors think if they gave the dealer 80,000 rupees and bought 1,000 pounds, at the end of the month, they would be able to exchange the pounds for 85,000 rupees, thus making a profit of 5,000 rupees. This expectation would increase the demand for pounds and cause the rupee-pound exchange rate to increase in the present, making the belief self-fulfilling. Interest rates and the exchange rate. In the short run, another factor that is important in determining exchange rate movements is the interest rate differential, i.e. the difference between interest rates between countries. There are huge funds owned by banks, multinational corporations, and wealthy individuals which move around the world in search of the highest interest rates. If we assume that government bonds in country A pay 8% rate of interest whereas equally safe bonds in county B yield 10%, the interest rate differential is 2%. Investors from country A will be attracted by the high interest rates in country B and will buy the currency of country B selling their own currency. At the same time, investors in country B will also find investing in their own country more attractive and will therefore demand less of country A's currency. This means that the demand curve for country A's currency will shift to the left and the supply curve will shift to the right, causing a depreciation of country A's currency and an appreciation of country B's currency. Thus, a rise in the interest rates at home often leads to an appreciation of the domestic currency. Here, the implicit assumption is that no restrictions exist in buying bonds issued by foreign governments. Income and the exchange rate. When income increases, consumer spending increases. Spending on imported goods is also likely to increase. When imports increase, the demand curve for foreign exchange shifts to the right. There is a depreciation of the domestic currency. If there is an increase in income abroad as well, domestic exports will rise and the supply curve of foreign exchange shifts outward. On balance, the domestic currency may or may not depreciate. What happens will depend on whether exports are growing faster than imports. In general, other things remaining equal, a country whose aggregate demand grows faster than the rest of the world normally finds its currency depreciating because its imports grow faster than its exports. Its demand curve for foreign currency shifts faster than its supply curve. Exchange rates in the long run. The purchasing power (PPP) theory is used to make long-run predictions about exchange rates in a flexible exchange rate system. According to the theory, as long as there are no barriers to trade like tariffs, taxes on trade, and quotas. 94 Introductory Macroeconomics. Quantitative limits on imports. Exchange rates should eventually adjust so that the same product costs the same whether measured in rupees in India, or dollars in the US, yen in Japan, and so on, except for differences in transportation. Over the long run, therefore, exchange rates between any two national currencies adjust to reflect differences in the price levels in the two countries. Example 6.1. If a shirt costs $8 in the US and 400 rupees in India, the rupee-dollar exchange rate should be 50 rupees. To see why, at any rate higher than 50 rupees, say 60 rupees, it costs 480 rupees per shirt in the US but only 400 rupees in India. In that case, all foreign customers would buy shirts from India. Similarly, any exchange rate below 50 rupees per dollar will send all the shirt business to the US. Next, we suppose that prices in India rise by 20% while prices in the US rise by 50%. Indian shirts would now cost 480 rupees per shirt while American shirts cost $12 per shirt. For these two prices to be equivalent, $12 must be worth 480 rupees, or $1 must be worth 40 rupees. The dollar, therefore, has depreciated. Fixed exchange rates. In this exchange rate system, the government fixes the exchange rate at a particular level. In Figure 6.3, the market-determined exchange rate is E. However, let us suppose that for some reason the Indian government wants to encourage exports for which it needs to make rupee cheaper for foreigners. It would do so by fixing a higher exchange rate, say 70 rupees per dollar from the current exchange rate of 50 rupees per dollar. Thus, the new exchange rate set by the government is E, where E greater than E. At this exchange rate, the supply of dollars exceeds the demand for dollars. The RBI intervenes to purchase the dollars for rupees in the foreign exchange market in order to absorb this excess supply, which has been marked as AB in the figure. Thus, through intervention, the government can maintain any exchange rate in the economy. But it will be accumulating more and more foreign exchange so long as this intervention goes on. On the other hand, if the government was to set an exchange rate at a level such as E, there would be an excess demand for dollars in the foreign exchange market. To meet this excess demand for dollars, the government would have to withdraw dollars from its past holdings of dollars. If it fails to do so, a black market for dollars may come up. In a fixed exchange rate system, when some government action increases the exchange rate, thereby making domestic currency cheaper, is called devaluation. On the other hand, a revaluation is said to occur when the government decreases the exchange rate, thereby making domestic currency costlier in a fixed exchange rate system. Foreign exchange market with fixed exchange rates. 95, 95, 95, 95, 95 Open Economy Macroeconomics. 6.2.3 Merits and demerits of flexible and fixed exchange rate systems. The main feature of the fixed exchange rate system is that there must be credibility that the government will be able to maintain the exchange rate at the level specified. Often, if there is a deficit in the BOP in a fixed exchange rate system, governments will have to intervene to take care of the gap by use of its official reserves. If people know that the amount of reserves is inadequate, they would begin to doubt the ability of the government to maintain the fixed rate. This may give rise to speculation of devaluation. When this belief translates into aggressive buying of one currency, thereby forcing the government to devalue, it is said to constitute a speculative attack on a currency. Fixed exchange rates are prone to these kinds of attacks, as has been witnessed in the period before the collapse of the Bretton Woods system. The flexible exchange rate system gives the government more flexibility, and they do not need to maintain large stocks of foreign exchange reserves. The major advantage of flexible exchange rates is that movements in the exchange rate automatically take care of the surpluses and deficits in the BOP. Also, countries gain independence in conducting their monetary policies since they do not have to intervene to maintain exchange rate, which are automatically taken care of by the market. 6.2.4 Managed floating. Without any formal international agreement, the world has moved on to what can be best described as a managed floating exchange rate system. It is a mixture of a flexible exchange rate system, the float part, and a fixed rate system, the managed part. Under this system, also called dirty floating, central banks intervene to buy and sell foreign currencies in an attempt to moderate exchange rate movements whenever they feel that such actions are appropriate. Official reserve transactions are, therefore, not equal to zero. Key concepts, EY concepts, EY concepts, EY concepts, EY concepts. Open economy, current account deficit, autonomous and accommodating transactions, purchasing power parity, depreciation, fixed exchange rate, managed floating, marginal propensity to import, open economy multiplier. Balance of payments, official reserve transactions, nominal and real exchange rate. Flexible exchange rate, interest rate differential, devaluation, demand for domestic goods, net exports. 96, 96, 96, 96, 96 Introductory Macroeconomics. 1. Differentiate between balance of trade and current account balance. 2. What are official reserve transactions? Explain their importance in the balance of payments. 3. Distinguish between the nominal exchange rate and the real exchange rate. If you were to decide whether to buy domestic goods or foreign goods, which rate would be more relevant? Explain. 4. Suppose it takes 1.25 yen to buy a rupee and the price level in Japan is 3 and the price level in India is 1.2. Calculate the real exchange rate between India and Japan, the price of Japanese goods in terms of Indian goods. Hint: first find out the nominal exchange rate as a price of yen in rupees. 5. Explain the automatic mechanism by which BOP equilibrium was achieved under the gold standard. 6. How is the exchange rate determined under a flexible exchange rate regime? 7. Differentiate between devaluation and depreciation. 8. Would the central bank need to intervene in a managed floating system? Explain why. 9. Are the concepts of demand for domestic goods and domestic demand for goods the same? 10. What is the marginal propensity to import when M equals 60 plus 0.06y? What is the relationship between the marginal propensity to import and the aggregate demand function? 11. Why is the open economy autonomous expenditure multiplier smaller than the closed economy one? 12. Calculate the open economy multiplier with proportional taxes T equals TI instead of lump sum taxes as assumed in the text. 13. Suppose C equals 40 plus 0.8 YD, T equals 50, I equals 60, G equals 40, X equals 90, M equals 50 plus 0.05 Y. A. Find equilibrium income. B. Find the net export balance at equilibrium income. C. What happens to equilibrium income and the net export balance when the government purchases increase from 40 and 50? 14. In the above example, if exports change to X equals 100, find the change in equilibrium income and the net export balance. 15. Suppose the exchange rate between the rupee and the dollar was Rs. 30 equals $1 in the year 2010. Suppose the prices have doubled in India over 20 years while they have remained fixed in USA. What, according to the purchasing power parity theory, will be the exchange rate between dollar and rupee in the year 2030? 16. If inflation is higher in country A than in country B and the exchange rate between the two countries is fixed, what is likely to happen to the trade balance between the two countries? 17. Should a current account deficit be a cause for alarm? Explain. 18. Suppose C equals 100 plus 0.75 YD, I equals 500, G equals 750, taxes are 20% of income, X equals 150, M equals 100 plus 0.2 Y. Calculate equilibrium income, the budget deficit or surplus and the trade deficit or surplus. 19. Discuss some of the exchange rate arrangements that countries have entered into to bring about stability in their external accounts. 97, 97, 97, 97, 97 Open Economy Macroeconomics. Determination of EI income in OE. With consumers and firms having an option to buy goods produced at home and abroad, we now need to distinguish between domestic demand for goods and the demand for domestic goods. National income identity for an open economy. In a closed economy, there are three sources of demand for domestic goods: consumption, C, government spending, G, and domestic investment, I. We can write Y equals C plus I plus G. 6.1. In an open economy, exports, X, constitute an additional source of demand for domestic goods and services that comes from abroad and therefore must be added to aggregate demand. Imports, M, supplement supplies in domestic markets and constitute that part of domestic demand that falls on foreign goods and services. Therefore, the national income identity for an open economy is Y plus M equals C plus I plus G plus X. 6.2. Rearranging, we get Y equals C plus I plus G plus X, M. 6.3. OR. Y equals C plus I plus G plus NX. 6.4. Where NX is net exports, exports, imports. A positive NX with exports greater than imports implies a trade surplus, and a negative NX with imports exceeding exports implies a trade deficit. To examine the roles of imports and exports in determining equilibrium income in an open economy, we follow the same procedure as we did for the closed economy case. We take investment and government spending as autonomous. In addition, we need to specify the determinants of imports and exports. The demand for imports depends on domestic income, Y, and the real exchange rate, R. Higher income leads to higher imports. Recall that the real exchange rate is defined as the relative price of foreign goods in terms of domestic goods. A higher R makes foreign goods relatively more expensive, thereby leading to a decrease in the quantity of imports. Thus, imports depend positively on Y and negatively on R. The export of one country is, by definition, the import of another. Thus, our exports would constitute a foreign imports. It would depend on foreign income, Y, and on R. A rise in Y will increase foreign demand for our goods, thus leading to higher exports. An increase in R, which makes domestic goods cheaper, will increase our exports. Exports depend positively on foreign income and the real exchange rate. Thus, exports and imports depend on domestic income, foreign income, and the real exchange rate. We assume price. Suggested readings. 1. Dornbush, R. and S. Fisher, 1994. Macroeconomics, 6th edition, McGraw-Hill, Paris. 2. Economic Survey, Government of India, 2006 to 2007. 3. Krugman, P.R. and M., Opsfeld, 2000. International Economics, Theory and Policy, 5th edition, Pearson Education. Appendix 6.1 Appendix 6.1 Appendix 6.1 Appendix 6.1 Appendix 6.1 98 98 98 98 98 Introductory Macroeconomics. Levels and the nominal exchange rate to be constant, hence R will be fixed. From the point of view of our country, foreign income and therefore exports are considered exogenous, X equals X. The demand for imports is thus assumed to depend on income and have an autonomous component. M equals M plus mi, where M greater than 0 is the autonomous component, 0, M less than 1. 6.5. Here M is the marginal propensity to import, the fraction of an extra rupee of income spent on imports, a concept analogous to the marginal propensity to consume. The equilibrium income would be y equals c plus c, yt plus I plus g, plus x, m, my. 6.6. Taking all the autonomous components together as A, we get y equals a plus I, my. 6.7. Or 1 c plus m, y equals a. 6.8. Or y equals 1 a c m plus. 6.9. In order to examine the effects of allowing for foreign trade in the income expenditure framework, we need to compare equation 6.10 with the equivalent expression for the equilibrium income in a closed economy model. In both equations, equilibrium income is expressed as a product of two terms, the autonomous expenditure multiplier and the level of autonomous expenditures. We consider how each of these change in the open economy context. Since M, the marginal propensity to import, is greater than 0, we get a smaller multiplier in an open economy. It is given by the open economy multiplier equals YA increment equals plus 1 cm. 6.10. Example. If C equals 0.8 and M equals 0.3, we would have the open and closed economy multiplier respectively as 1 C equals 1 minus 0.8 is equal to 1 0.2 is equal to 5. 6.11. And plus 1 cm equals plus 1 to 0.8 0.3 is equal to 1 0.5 is equal to 2. 6.12. If domestic autonomous demand increases by 100 in a closed economy, output increases by 500, whereas it increases by only 200 in an open economy. The fall in the value of the autonomous expenditure multiplier with the opening up of the economy can be explained with reference to our previous discussion of the multiplier process, Chapter 4. A change in autonomous expenditures, for instance a change in government spending, will have a direct effect on income and an induced effect on consumption with a further effect on income. With an MPC greater than 0, a proportion of the induced effect on consumption will be a demand for foreign, not domestic goods. Therefore, the induced effect on demand for domestic goods and hence on domestic income will be smaller. The increase in imports per unit of income constitutes an additional leakage from the circular flow of domestic income at each round of the multiplier process and reduces the value of the autonomous expenditure multiplier. The second term in equation 6.10 shows that, in addition to the elements for a closed economy, autonomous expenditure for an open economy includes the level of exports and the autonomous component of imports. Thus, the changes in their levels are additional shocks that will change equilibrium income. From equation 6.10, we can compute the multiplier effects of changes in x and m. Asterisk yx increment equals plus 1 cm. 6.13. Asterisk ym increment equals plus minus 11 cm. 6.14. An increase in demand for our exports is an increase in aggregate demand for domestically produced output and will increase demand just as would an increase in government spending or an autonomous increase in investment. In contrast, an autonomous rise in import demand is seen to cause a fall in demand for domestic output and causes equilibrium income to decline. Adam Smith, 1723–1790, regarded as the father of modern economics. Author of Wealth of Nations. Aggregate monetary resources, broad money without time deposits of Post Office Savings Organization, M3. Automatic stabilizers under certain spending and tax rules, expenditures that automatically increase or taxes that automatically decrease when economic conditions worsen, therefore stabilizing the economy automatically. Autonomous change, a change in the values of variables in a macroeconomic model caused by a factor exogenous to the model. Autonomous expenditure multiplier, the ratio of increase or decrease in aggregate output or income to an increase or decrease in autonomous spending. Balance of payments, a set of accounts that summarize a country's transactions with the rest of the world. Balanced budget, a budget in which taxes are equal to government spending. Balanced budget multiplier, the change in equilibrium output that results from a unit increase or decrease in both taxes and government spending. Bank rate, the rate of interest payable by commercial banks to RBI if they borrow money from the latter in case of a shortage of reserves. Barter exchange, exchange of commodities without the mediation of money. Base year, the year whose prices are used to calculate the real GDP. Bonds, a paper bearing the promise of a stream of future monetary returns over a specified period of time. Issued by firms or governments for borrowing money from the public. Broad money, narrow money plus time deposits held by commercial banks and Post Office Savings Organization. Capital factor of production, which has itself been produced and which is not generally entirely consumed in the production process. Capital gains/loss, increase or decrease in the value of wealth of a bondholder due to an appreciation or reduction in the price of her bonds in the bond market. Capital goods, goods which are bought not for meeting immediate need of the consumer but for producing other goods. Capitalist country or economy, a country in which most of the production is carried out by capitalist firms. Capitalist firms, these are firms with the following features: A. Private ownership of means of production. B. Production for the market. C. Sale and purchase of labor at a price which is called the wage rate. D. Continuous accumulation of capital. Cash reserve ratio, CRR, the fraction of their deposits which the commercial banks are required to keep with RBI. Circular flow of income, the concept that the aggregate value of goods and services produced in an economy is going around in a circular way, either as factor payments or as expenditures on goods and services or as the value of aggregate production. Consumer durables, consumption goods which do not get exhausted immediately but last over a period of time are consumer durables. Consumer price index, CPI, percentage change in the weighted average price level. We take the prices of a given basket of consumption goods. Consumption goods, goods which are consumed by the ultimate consumers or meet the immediate need of the consumer, are called consumption goods. It may include services as well. Corporate taxes imposed on income made by the corporations or private sector firms. Currency deposit ratio, the ratio of money held by the public in currency to that held as deposits in commercial banks. Deficit financing through central bank borrowing, financing of budget deficit by the government through borrowing money from the central bank, leads to increase in money supply in an economy and may result in inflation. Depreciation, a decrease in the price of the domestic currency in terms of the foreign currency under floating exchange rates. It corresponds to an increase in the exchange rate. Depreciation, wear and tear or depletion which capital stock undergoes over a period of time. Devaluation, the decrease in the price of domestic currency under pegged exchange rates through official action. Double coincidence of wants, a situation where two economic agents have complementary demand for each other's surplus production. Economic agents or units, economic units or economic agents are those individuals or institutions which take economic decisions. Effective demand principle, if the supply of final goods is assumed to be infinitely elastic at constant price over a short period of time, aggregate output is determined solely by the value of aggregate demand. This is called effective demand principle. Entrepreneurship, the task of organizing, coordinating and risk-taking during production. Ex ante consumption, the value of planned consumption. Ex ante investment, the value of planned investment. Ex ante, the planned value of a variable as opposed to its actual value. Ex post, the actual or realized value of a variable as opposed to its planned value. Expenditure method of calculating national income, method of calculating the national income by measuring the aggregate value of final expenditure for the goods and services produced in an economy over a period of time. Exports, sale of goods and services by the domestic country to the rest of the world. External sector, it refers to the economic transaction of the domestic country with the rest of the world. Externalities, those benefits or harms accruing to another person, firm or any other entity which occur because some person, firm or any other entity may be involved in an economic activity. If someone is causing benefits or good externality to another, the latter does not pay the former. If someone is inflicting harm or bad externality to another, the former does not compensate the latter. Fiat money, money with no intrinsic value. Final goods, those goods which do not undergo any further transformation in the production process. Firms, economic units which carry out production of goods and services and employ factors of production. Fiscal policy, the policy of the government regarding the level of government spending and transfers and the tax structure. Fixed exchange rate, an exchange rate between the currencies of two or more countries that is fixed at some level and adjusted only infrequently. Flexible/floating exchange rate, an exchange rate determined by the forces of demand and supply in the foreign exchange market without central bank intervention. Flows, variables which are defined over a period of time. Foreign exchange, foreign currency, all currencies other than the domestic currency of a given country. Foreign exchange reserves, foreign assets held by the central bank of the country. For factors of production, land, labor, capital, and entrepreneurship. Together these help in the production of goods and services. GDP deflator, ratio of nominal to real GDP. Government expenditure multiplier, the numerical coefficient showing the size of the increase in output resulting from each unit increase in government spending. Government, the state, which maintains law and order in the country, imposes taxes and fines, makes laws and promotes the economic well-being of the citizens. Great Depression, the time period of 1930s, started with the stock market crash in New York in 1929, which saw the output in the developed countries fall and unemployment rise by huge amounts. Gross domestic product, GDP, aggregate value of goods and services produced within the domestic territory of a country. It includes the replacement investment of the depreciation of capital stock. Gross fiscal deficit, the excess of total government expenditure over revenue receipts and capital receipts that do not create debt. Gross investment addition to capital stock, which also includes replacement for the wear and tear which the capital stock undergoes. Gross national product, GNP, GDP plus net factor income from abroad. In other words, GNP includes the aggregate income made by all citizens of the country, whereas GDP includes incomes by foreigners within the domestic economy and excludes incomes earned by the citizens in a foreign economy. Gross primary deficit, the fiscal deficit minus interest payments. High-powered money injected by the monetary authority in the economy. Consists mainly of currency. Households, the families or individuals who supply factors of production to the firms and which buy the goods and services from the firms. Imports, purchase of goods and services by the domestic country to the rest of the world. Income method of calculating national income. Method of calculating national income by measuring the aggregate value of final factor payments made equals income in an economy over a period of time. Interest payment for services which are provided by capital. Intermediate goods which are used up during the process of production of other goods. Inventories, the unsold goods and used raw materials or semi-finished goods which a firm carries from a year to the next. John Maynard Keynes, 1883 to 1946, arguably the founder of macroeconomics as a separate discipline. Labor, human physical effort used in production. Land, natural resources used in production, either fixed or consumed. Legal tender, money issued by the monetary authority or the government which cannot be refused by anyone. Lender of last resort, the function of the monetary authority of a country in which it provides guarantee of solvency to commercial banks in a situation of liquidity crisis or bank runs. Liquidity trap, a situation of very low rate of interest in the economy where every economic agent expects the interest rate to rise in future and consequently bond prices to fall, causing capital loss. Everybody holds her wealth in money and speculative demand for money is infinite. Macroeconomic model, presenting the simplified version of the functioning of a macroeconomy through either analytical reasoning or mathematical, graphical representation. Manage, floating, a system in which the central bank allows the exchange rate to be determined by market forces but intervene at times to influence the rate. Marginal, propensity to consume, the ratio of additional consumption to additional income. Medium of exchange, the principal function of money for facilitating commodity exchanges. Money multiplier, the ratio of total money supply to the stock of high-powered money in an economy. Narrow money, currency notes, coins and demand deposits held by the public in commercial banks. National disposable income, net national product at market prices plus other current transfers from the rest of the world. Net domestic product, NDP, aggregate value of goods and services produced within the domestic territory of a country which does not include the depreciation of capital stock. Net interest payments made by households, interest payment made by the households to the firms, interest payments received by the households. Net investment addition to capital stock, unlike gross investment, it does not include the replacement for the depletion of capital stock. Net national product, NNP, at market price, GNP, depreciation. NNP at factor cost or national income, NI, NNP at market price, indirect taxes, subsidies. Nominal exchange rate, the number of units of domestic currency one must give up to get an unit of foreign currency, the price of foreign currency in terms of domestic currency. Nominal, GDP, GDP evaluated at current market prices. Non-tax payments, payments made by households to the firms or the government as non-tax obligations such as fines. Open market operation, purchase or sales of government securities by the central bank from the general public in the bond market in a bid to increase or decrease the money supply in the economy. Paradox of thrift, as people become more thrifty they end up saving less or same as before in aggregate. Parametric shift of a graph due to a change in the value of a parameter. Personal disposable income, PDI, PI, personal tax payments, non-tax payments. Personal income, PI, NI, undistributed profits, net interest payments made by households, corporate tax plus transfer payments to the households from the government and firms. Personal tax payments, taxes which are imposed on individuals, such as income tax. Planned change in inventories, change in the stock of inventories which has occurred in a planned way. Present value of a bond, that amount of money which, if kept today in an interest-earning project, would generate the same income as the sum promised by a bond over its lifetime. Private income factor, income from net domestic product accruing to the private sector plus national debt interest plus net factor income from abroad plus current transfers from government plus other net transfers from the rest of the world. Product method of calculating national income, method of calculating the national income by measuring the aggregate value of production taking place in an economy over a period of time. Profit payment for the services which are provided by entrepreneurship. Public goods or services that are collectively consumed, it is not possible to exclude anyone from enjoying their benefits and one person's consumption does not reduce that available to others. Purchasing power parity, a theory of international exchange which holds that the price of similar goods in different countries is the same. Real exchange rate, the relative price of foreign goods in terms of domestic goods. Real GDP, GDP evaluated at a set of constant prices. Rent payment for services which are provided by land, natural resources. Reserve deposit ratio, the fraction of their total deposits which commercial banks keep as reserves. Revaluation, a decrease in the exchange rate in a pegged exchange rate system which makes the foreign currency cheaper in terms of the domestic currency. Revenue deficit, the excess of revenue expenditure over revenue receipts. Ricardian equivalence, the theory that consumers are forward-looking and anticipate that government borrowing today will mean a tax increase in the future to repay the debt, and will adjust consumption accordingly so that it will have the same effect on the economy as a tax increase today. Speculative demand for money as a store of wealth. Statutory liquidity ratio, SLR, the fraction of their total demand and time deposits which the commercial banks are required by RBI to invest in specified liquid assets. Sterilization, intervention by the monetary authority of a country in the money market to keep the money supply stable against exogenous or sometimes external shocks such as an increase in foreign exchange inflow. Stocks, those variables which are defined at a point of time. Store of value, wealth can be stored in the form of money for future use. This function of money is referred to as store of value. Transaction, demand for money for carrying out transactions. Transfer payments to households from the government and firms. Transfer payments are payments which are made without any counterpart of services received by the payer. Transfer payments to households from the government and firms. Transfer payments are payments which are made without any counterpart of services received by the payer. For examples, gifts, scholarships, pensions. Undistributed profits, that part of profits earned by the private and government-owned firms which are not distributed among the factors of production. Unemployment rate, this may be defined as the number of people who were unable to find a job, though they were looking for jobs, as a ratio of total number of people who were looking for jobs. Unit of account, the role of money as a yardstick for measuring and comparing values of different commodities. Unplanned change in inventories, change in the stock of inventories which has occurred in an unexpected way. Value added, net contribution made by a firm in the process of production. It is defined as value of production, value of intermediate goods used. Wage payment for the services which are rendered by labor. Wholesale price index, WPI, percentage change in the weighted average price level. We take the prices of a given basket of goods which is traded in bulk.